the entire chapter as per amended provision, and that is what right now we are doing. Capital gains, right now we are discussing straight away the amended provision. And you listen to this particular revision of capital gains, I'm telling you, you generally get complete clarity. Everywhere, wherever amendment is there, I will specifically point out. Okay, now in capital gains, the major thing is there are 4 dates that you should remember in this chapter, and there are 4 rates that you should remember in this chapter. These rates are applicable for long-term capital gains. These rates are applicable for short-term capital gains. 111A section. There is another short-term capital gain which is taxable at normal rates. There is another capital gain, another short-term capital gain which is applicable at normal rate. But don't worry, let's not discuss immediately into this. 4 dates, 4 rates. This point I will come back. Okay, this point I will come back. What are the 4 rates that are there in the capital gains? What are the 4 dates that are available in capital gains? I'll come back. Now, most important, in capital gains, how do we compute capital gains? This is the first question. Normally, when you're learning capital gains, in what order you learn, that's different. But when you're revising the capital gain, there is a particular order in which you should revise. Therefore, you get ultimate command of the subject. Now, how to what is the, let's begin the actual capital gains revision discussion. Capital gains, will be computed in 2 parts. Capital gains can be computed in 2 different ways. One, for non-depreciable assets. Capital gains is computed for what? Non-depreciable assets. And depreciable assets. What is it? Depreciable assets. Non-depreciable assets, capital gain computation is available under 48. Depreciable assets, capital gain computation is given under 50 and 50A. Apart from this, there are few more sections which talk about computation of capital gain. There are few more sections which talk about computation of capital gains, that is 46, liquidation, on account of liquidation. Then 46A, computation of capital gain on buyback. Computation of capital gains on buyback. There is another section which is also talking about capital gains for market linked debentures, units of specified mutual fund, unlisted debentures, unlisted bonds with effect from 23rd July. This section has an amendment. Getting it? And there is another section which also talks about computation of capital gain is slump sale. There is another section which is also talking about computation of capital gain is slump sale. Now, so this is the capital gain computation format. This is the situations under which you should compute capital gains. Remember, don't deviate. There is an order in which I am discussing. If you listen to this order, if you listen through this order, every point I will connect. Now, how to compute capital gains for depreciable assets? First, let us look at this. Already, this point we will discuss in PGBP revision. We would have already discussed this in PGBP revision, but briefly once again I will tell you. How to compute capital gains on depreciable assets? Very simple. In depreciable assets, you sold full block. You sold full block. Full block is transferred. Full block is transferred. As on 31st March of the relevant previous year, a particular block is not at all there. 1st April the block is there, but 31st March the block is not there, which means the block itself is ceased to exist. Now, how to compute capital gains? First, identify gross block value. First, identify gross block value. What do you mean by gross block value? Opening WDV plus additions during the year plus transfer expenses during that year. Transfer expenses incurred on transfer of the block. See, this point is what I already given you in the book also. In the book also, I have clearly given you this point. This point I have given, just a minute, it's loading. Yeah. You see here, section 50. Section 50. How to compute capital gains on depreciable assets which are forming part of block of asset. Very simple. Sir, full block is transferred. Yes. Short term amount is, look at the amount received. Sir, how much amount you received? Check out. Amount received is more than gross block value. Then amount received minus gross block value is treated as short term capital gain. Sir, full block is transferred. Sir, amount received is less than gross block value. then it is a short-term capital loss. Sir, I transferred part of a block. I transferred part of a block. And the amount received is more than value of the block itself. Then the excess amount received is short-term capital gain. Suppose part of a block is transferred, sir. The amount received is less than gross block value, sir. 32 section will apply. Opening value plus additions minus amount received on transfer of a block, part of a block. Still some value is there, WDV. It's called WDV. Written down value is there. Asset is also there. Block is also there as on 31st March. You will not compute capital gains at all. Correct? So now, how to compute capital gains? Amount received, gross block value you should compare. Correct? You should compare amount received. Amount received minus gross block value. If the net result is positive, it's a short-term capital gain. If the net result is negative, it's a short-term capital loss. Correct? Amount received minus gross block value. Now, amount received means what? Value of consideration received on transfer. Transfer means what? The block, no, either it would have been sold, or the block is demolished, or block is compulsorily acquired by somebody. Some transfer happened. You received some amount. Block itself is not there. Compare that amount received with the gross block value. What is gross block value? Opening value of the block, add actual cost of asset acquired in the block during the year, add, very important, expenses in connection with transfer. For computation of capital gains, expenses incurred in connection with regard to transfer shall also be treated as gross block value. So very simple, sale value, full value minus transfer expenses is equal to net value minus gross block value. That's how you can compute. But instead of that, you compare these three. Simple. Full block itself is sold, sir. Some amount you got. Full block itself is sold. Some amount you got. Compare it with the gross block value. Difference amount is either short-term capital gain or short-term capital loss. That's it. Very simple example I'll give you here. Suppose, sir, opening value of plant and machinery 15% block. Open value of plant and machinery 15% block. This is 100 crores, sir. Current year, no, more than 180 days, less than 180 days. So I purchased so many assets, sir, which is 20 crore. Total gross block value is what? 120 crore. Now, this entire block, no, sir, entire block, we sold for 150 crores, sir. Short-term capital gain is 30 crore. Don't compute like this. If you see the question, you understood that full block is sold. You saw the question, you understood that full block is sold. Immediately, your mind should think about how to present it in such a way. Very simple. Amount received on transfer of full block, correct? How much it is? 150 minus transfer expenses, some 1 crore was there, 149 net consideration, correct? Minus gross block value, opening plus additions during the year. Opening 100 crore, additions 20, so 120. Therefore, balance is short-term capital gain. Balance is to be treated as short-term capital gain. You should think about the process. First, you should think capital gains applicable or not applicable. Then you should immediately come to this format when you're doing. Are you getting it? Sir, part of a block sold. Here, instead of using the word part, you will use. In a part of a block sale, you will only have gain or you will have depreciation. Sir, part full block sold, sir, but lesser price, sir. If it is negative, it's a short-term capital loss. If it is negative, it's a short-term capital loss. Able to understand. You should present like this. Sale you should present, transfer expenses should reduce, then gross block value should reduce, and the final result will be either short-term capital gain or short-term capital loss when full block is transferred. Sir, part of a block only transferred, sir. Part of a block is transferred, sir. But you know that capital gains apply in that. Why? When part of a block is sold for higher than block value, automatically what is applicable? Capital gains is applicable. Depreciation will not apply. Since capital gains is applicable, same format you will follow. Amount received on part of a block, 150 crores, sir. Gross block value 120 only. Obviously, capital gains provision will apply. Therefore, my format will be like this. Suppose, no, sir, amount received on part of a block is 100, sir. Full block value is 120, sir. Capital gain section will not apply. Section 50 will not apply. Directly, I will go for 32. Depreciation format will follow. Opening WDV 100. Additions 20. Gross block value 120. Minus part of a block sold. Net amount you reduce. After reducing transfer expenses, net amount. After reducing transfer expenses, reduce that amount received. Amount received 20 crore, sir. Minus transfer expenses 1 crore is there, sir. 19 crore you reduce. Still balance is there. Block is there. Compute depreciation as we discussed in PGBP. First, allocate that amount for assets not used, purchased but not used. Second, allocate the value for assets purchased during the year but used for less than 180. Balancing figure. Second amount is there, right? Half rate. Balancing figure, full rate. This we already covered in PGBP. Clear? That's it. Depreciation as a depreciable assets logic is over. And on depreciable assets, the capital gain is always long term. Sorry, the capital gain is always short term. Loss is short term. That's it. 50 is over. Now, sir, I am an electricity company, sir. 50A. I am an electricity company which is following SLM basis of accounting. Sorry, which is where I am following SLM basis of depreciation, sir. How to compute capital gains? You will have WDV on opening date, right? On 1st April of the previous year, you will have opening date, right? As on 31st March, you will compute depreciation. But as on 31st March, that asset is sold. For that year, you don't get depreciation at all. For that year, you don't get depreciation at all. If an electricity company purchased a machine, SLM method, they are depreciating. As on 1st April, opening value find out. That asset is sold during the year. No depreciation for this year. Are you getting it? Sir, opening value of this is 50 crores, sir. I purchased this asset for 100 crores, sir. Now I sold it for 150 crore. I sold it now for what price? 150 crore. Now, remember opening value as on 1st April is 1st April 2024 is 50 crore. You know, I purchased originally for 100. Now I sold it for what price? 150. Now how to compute? Very simple. Total profit is what? 150 crore is the sale price. 50 crore is the, you know, WDV. Total profit is 100 crore. Total profit is 100. But this 100 will be split into two parts. Profit up to original cost. WDV is 50 only. But I sold for 150. 100 crore profit is there. How much of the profit is up to original cost? 50. This 50 crore is treated as balancing charge. This 50 crore is treated as balancing charge under 43 subsection 2. What is that? 43 subsection 2. Sir, balance 50 crore is there, right? Beyond original cost profit. That is treated as short-term capital gain under 50EA. That is treated as short-term capital gain under 50EA. That's it. Sir, actually WDV 50, sir. I sold this asset for 10 crore only, sir. Then 50 minus 10, what is the loss? 40 crore. This is straight away treated as terminal depreciation under section 32. It is straight away treated as terminal depreciation under section 32. This we already covered once in PGBP. That's it. Section 50, depreciable asset. How to compute capital gains, we completed. 50A, how to compute capital gains, we completed. And that entire points were given in this. This entire point, transfer of depreciable assets, all that we have given here. Clear? Next. Then 50AA, most important amendment is there. 50AA amendment is there, which is applicable for May 25 exams for the first time. And I'm thinking there is a possibility of MCQ on this. What is this? 50AA is what? This 50AA section, no? This 50AA section. Okay? I am talking about before amendment and after amendment. Both. I am talking about before amendment, after amendment. Before amendment means what? Before 23rd July 2024 on or after 23rd July 2024. 23rd July is most important date in capital gains, remember. Now, one date is what? Before 23rd July, on or after 23rd July. How this section is modified? That is the question. Before 23rd July, only two types of assets are covered under 50AA. Only two types of assets. Specified mutual fund. What is it? Specified mutual fund. Market linked debenture. Whereas after amendment, the assets are covered. Specified mutual fund as it is there, market linked debenture as it is there, unlisted debenture, unlisted bonds were also added with effect from 23rd July 2024. With effect from 23rd July 2024, Unlisted debentures and unlisted bonds are also added. Unlisted debentures and unlisted bonds are also added within the purview of 50AA. Sir, what is 50AA? 50AA is very simple. 50AA says the capital gain on the section, on the assets covered under the section, the capital gain, the capital loss, whatever it is. If at all the asset comes under 50AA section, the gain or loss is always short-term capital gain or short-term capital loss. This is what the section says. The section says whatever assets covered under that section, the gain or loss is always treated as short-term, irrespective of holding period. Irrespective of holding period. Now, sir, I purchased specified mutual funds, market linked debentures, which I purchased and sold before 23rd July, or I purchased before 23rd July, sir, but sold after 23rd July. Here what I am doing, transferred on or after 23rd July. Here what am I doing, transferred. What you transferred, sir, before 23rd July, mutual funds. Before 23rd July, I transferred mutual funds, specified mutual funds. Specified mutual funds is generally debt-oriented mutual funds. Generally, what are they? Debt-oriented. Debt-oriented means what? Where investment in equity shares of domestic companies less than 65%. Investment in equity shares, investment in equity shares is not more than 35%. Not more than 35%. Predominantly 65% or more than 65% is invested in debt or bonds. Then that is called as what? Specified mutual fund. It is given here. What is a specified mutual fund? A mutual fund where not more than 35 is invested in equity shares. Means equity share investment portion is how much? Less than or equal to 35. Indirectly 65% is invested in preference shares, debentures, bonds, something debt oriented. Getting it? Now, if at all I am selling these two items, whether I am selling before 23rd July or after 23rd July, doesn't matter. The gain or loss is always short term. However, latest amendment, unlisted debentures, unlisted bonds. Unlisted debentures and unlisted bonds. Sir, I am selling unlisted debentures, sir. Right now I am selling unlisted debenture. Or I am selling unlisted bonds, sir. When are you selling? I am selling after 23rd July. I am selling them well after 23rd July. Before 23rd July, I purchased it, sir. When you purchase it, not matter. When you sold, sir, I sold after 23rd July. On 23rd July 2024 or after 23rd July 2024, I transfer. For May 25 exam, September 25, Jan 25, problems will be asked based on financial year 24-25, previous year 24-25. This is very important. So unlisted debentures, unlisted bonds, I sold after, on or after 23rd July. Very simple. On this, sir, this asset is a long term for me, sir. It doesn't matter. The gain is always short term. The gain is always short term. The asset may be long term. Asset may be long term. By the way, whether an asset is a long term or short term, whether an asset is a long term or short term, it depends upon what? Period of holding. Whether an asset is a long term asset or short term asset, it depends upon what? Period of holding. Now let's discuss that point first. Okay, we have a section called 2 subsection 42A and 2 subsection 29A. 242A talks about short term capital asset. 229A talks about long term capital asset. 229A section says what is a long term other than short term. What is a short term capital asset? Now the section gave two parts. Now what is a short term capital asset? Again it is divided into two parts. Very simple. I'll open to that directly, so you will get a view, or you will get a holistic view. You see, types of capital asset. Types of, you see capital gains chapter here, it starts here, and types of capital asset. Capital gains are broadly classified into long term and short term based on period of holding of the capital asset. Based on period of holding, capital assets are two types. What are they? Short term capital asset, long term capital asset. That when an asset is treated as short term, when an asset is treated as long term, this is the question. It depends upon what? Period of holding. Now, this classification of capital asset into long term, short term, the provision is different. If at all asset is sold before 23rd July. Suppose you sold asset before 23rd July. Tell me, capital gains set of income is applicable only when there is a transfer of capital asset. Transfer is the taxable event. When the transfer happened, check out. Sir, transfer happened after 23rd July, sir. On or after 23rd July. From 23rd July, there are only two criteria. For highly volatile assets. I am naming it. This name is given by me. Highly volatile assets. What are the assets? Nothing but listed securities. Listed securities means what? It may be listed equity shares, listed preference shares, listed bonds, listed debentures, all that other than units. Mutual funds is not covered here. In that first point, mutual fund is not covered. Listed securities. What is the criteria? 12 months. If at all holding period is up to 12 months, it's a short term. If the holding period is beyond 12 months, it's a long term. If the holding period is up to 12 months, it's a short term. If the holding period is more than 12 months, it's a long term. You see, before amendment also the same. For highly volatile assets. Highly volatile assets means what? Listed securities, units of equity oriented, units of unit trust of India, zero coupon bonds. Remember, what are highly volatile assets? Listed securities. Units of only equity oriented fund. Debt oriented funds are not covered in 12 months category. Debt oriented mutual funds are not covered under 12 months category. Only equity oriented mutual funds are covered under 12 months category. Yes or no? So listed securities, units of equity fund, unit trust of India, zero coupon bonds. If these assets are sold after 23rd July, 12 months is the criteria. Even if you sell before 23rd July, same as above. 12 months is the criteria. Understood? Now, after amendment, from 23rd July, you are selling some capital asset other than volatile assets. Straight away, the criteria is what? 24 months. What are they? Unlisted securities. What are they? Unlisted securities. Debt-oriented mutual funds. Immovable property. Jewelry. Yes or no? All these items. Urban agricultural land. Industrial land and building. All these items. Straight away the criteria is what? 24 months. You know, before amendment, we have two classifications for these assets. Unlisted shares, land and building are both remaining assets. Before amendment, we have 12 months logic, 24 months logic, 36 months logic. Whereas after amendment, we have only two logics, 12 months, 24 months. Before amendment, suppose, sir, I am selling an asset, sir. Before 23rd July, I am selling. You are selling before 23rd July. Okay, I am selling before 23rd July, sir. What is the consequence? Which asset you sold? Highly volatile asset. 12 months is the logic. Or I sold unlisted shares. Remember, it's not unlisted security, unlisted share. Unlisted share means what? Either equity share is covered, preference share is covered, debenture is not covered, bond is not covered there. Understood? Debenture is not covered, unlisted debenture, unlisted bonds not covered. Zero coupon bond is covered under highly volatile asset. Zero coupon bond is covered under highly volatile. Highly volatile means what? Listed securities. You know, equity oriented mutual fund, unit trust of India, zero coupon bonds. For them it is always 12 months. Before amendment, after amendment, no change. Whereas unlisted shares, only preference and equity, only they are eligible for 24 months criteria. Remaining unlisted securities, unlisted debentures, unlisted bonds, they still come under 36 months criteria if at all you are selling those debentures and bonds before 23rd July. Suppose I am selling a debenture and bond after 23rd July. 24 months is enough. 24 months is enough. See here, very important. Why long term and short term classification is important? Why it is important? Because tax rate is decided accordingly. You should decide an asset is a long term or short term because tax rate is important. Now very simple. Unlisted shares, land, building or both. For them, what is the criteria? 24. Remaining assets means what? Unlisted debenture, unlisted bond, jewelry. Yes or no? For all jewelry, archaeological collection, painting, drawing, for all this straight away 36. Whereas after amendment, what happened? These items are also classified under 25. 24 months. These items are also classified under 24 months category. Earlier, unlisted debentures, earlier, unlisted shares, immovable property. Only these two assets come under 24 months logic. Remaining all other comes under 36 months logic. After amendment from 23rd July, every asset other than highly volatile asset comes under 24 months logic. Highly volatile assets are 4. Remember this: listed securities, units of equity oriented mutual funds, zero coupon bonds, units of unit trust of India. Remember, there is a point: units of business trust. For that, before amendment, 36 months criteria is applicable. After amendment, 24 months criteria is applicable. Until now, clear? All of you. This is short-term capital asset, long-term capital asset definition. Over. Now you see here 50A, right? Sir, I am selling unlisted debentures, unlisted bonds, sir. When you are selling, before 23rd July, I am selling, sir. 50A section do not apply. I am selling unlisted debenture, unlisted bonds before 23rd July. That time 50A section is not applicable. If it is a long term, gain is long term capital gain. If it is a short term, gain is short term capital gain. Before 23rd July you are selling means holding period is 36 months criteria. Before 23rd July if you are selling, holding period criteria is 36 months. If it is a long term capital gain. If it is a short term capital gain. Simple. But if you are selling after, on or after 23rd July, then 24 months criteria. It may be a long term or it may be a short term. But the profit or loss is always short. With effect from 23rd July, unlisted debentures, unlisted bonds is also covered within the scope of section 50AA. That's it. Understood? All of you? That's it. Now we also completed long-term capital asset means what, short-term capital asset means what. Now, what are the capital gains tax rates? Let's now look at the capital gains tax rate. So that is given in our book at the last. At the last of this chapter, we have given what is the tax rates. Just a minute. Yes. What are the tax rates? There are, at the beginning I told, right, four rates concept that I am thinking now. Okay. Now, see, there are three types of assets. There are three types of assets. What are they? Listed equity share. Listed equity share. Listed equity oriented mutual fund. Units of business trust. Units of business trust. Business trust taxation is not there in CA Intro. That's why we will not get anywhere business trust related cost of acquisition, business trust related market value. If you don't get that, business trust is a different entity where the taxation is available at CA final only. Okay. Now, sir, I am having three assets, sir. Listed equity shares, listed equity oriented mutual funds, units of business trust. Okay. Okay. You are selling these assets. Yes, sir, I am selling these assets. By the way, for this, holding period criteria is what just now we covered. Listed equity shares comes under highly volatile. Listed securities logic, 12 months logic. Equity oriented mutual funds comes under 12 months logic. Units of business trust, if at all you are selling before 23rd July 2024, 36 months logic. If at all you are selling after 23rd July 2024, then 24 months logic will apply. By the way, up to 12 months, up to 24, up to 36, as the case may be, is a short term. Beyond 12 months, beyond 24, exceeding 12, exceeding 24, exceeding 36 only, it's a long term. That beyond up to exceeding point I didn't cover, that's why I'm touching it now. Now understood, everyone? Yes. So now we understood these three assets, when they will become long term, when they will become short, when they will become a long term asset, when they will become a short term, we understood. Exceeding 12 months is a long term. Exceeding 12 months is a long term. Suppose units of business trust before amendment I sold. I sold before amendment. That time holding period is what? More than 36. After amendment I sold. Then holding period must be more than 24 months. Sir, what is holding period? From which date you got the asset? On which date you are selling it? If the gap is more than 12, more than 24, more than 36, then it's a long term. If the gap is less than or equal to 12, less than or equal to 24, less than or equal to 36, then it is a short term. Correct? Now look at these three assets. What is these three assets? These three assets are covered under two sections, 112A, 111A. These three sections are covered under two different sections called 112A, 111A. Sir, these three assets I sold, sir. Any of these three. Suppose if it is a long-term capital asset. If it is a long-term capital asset. Sir, I sold, which is a long-term capital asset, sir. These three assets I sold, sir. Long-term capital assets, sir. Moreover, more than 12 months. After holding them for more than 12 months, I sold it. Now, what is the tax rate applicable to me? This is the question. When you sold, I want. You sold before 23rd July? You sold before 23rd July? Or you sold on or after 23rd July? I want. You sold on or after 23rd July? Yeah, before 23rd July? I want. Sir, I sold before 23rd July, sir. Straight away tax rate is what? 10%. You all know this. Exceeding 1 lakh. No, it's not 1 lakh. It's 1.25 lakh. For financial year 24-25. Up to how much of 112A gain is exempted when computing tax amount? 1.25 lakh is exempted. Whether you transferred before 23rd or after 23rd doesn't matter. Many students thinking up before 23rd 1 lakh limit, after 23rd 1.25 lakh. This is not a separate limit. For full year put together, only 1.25 lakh limit. Are you getting it? No. Sir, I sold before 23rd July, sir. Or I sold on or after 23rd July, sir. On or after 23rd July you sold, huh? Which one you sold, by the way? Sir, I sold these three, sir. Either listed equity share, listed equity oriented mutual fund, units of business trust, STT paid, sir. STT paid. What do you mean by STT paid? I'll discuss little while later. STT paid, sir. At the time of sale, STT paid, sir. Then, if the asset is a long term, before 23rd July, if at all you sell, you have a long term capital gains, it is taxable at 10%. Suppose if at all you are selling it after on or after 23rd July, the tax amount is 12.5. Whether it is before or after a total capital gain, you compute first. Total capital gain you compute. On that 1.25 lakh give exemption. On that give exemption 1.25 lakh. Getting it? Balance capital gain is taxable. For example, sir, before 23rd July I sold, sir, I got 5 lakhs capital gain. Okay? And after 23rd July, I sold another listed equity share, sir. That is also long term, sir. Here also I got 5 lakhs capital gain. Now, how to compute tax, sir? Very simple. From this 5 lakhs, 1.25 lakh reduce. First in, first out. FIFO order we will reduce. 1.25 lakh we will reduce in which order? FIFO. 1.25 I reduced it, sir. Balance 3.75 lakh. This entire gain is came before 23rd July. Taxable at 10%. You know, here 1.25 already claimed exemption. 5 lakh is taxable at what rate? 12.5% is equal to that amount is the tax. 112A, how to compute tax? Crystal clear, I told. Many students are thinking before amendment 1 lakh, after amendment 1.25 lakh, they are reducing both. Wrong. It's absolutely wrong. 1.25 lakh is the limit for the entire capital gain taxable in that year. Now that 1.25 lakh is exempted, first capital gain, first 1.25 lakh of capital gain is exempted. Balance capital gain is taxable. That is what the provision. First 1.25 lakh is exempt. Beyond 1.25 lakh is taxable. First capital gain means, before 23rd July I got a capital gain. That is first capital gain for me in this year. So that's why I will give exemption here. How much I will give exemption? 1.25 lakh. Now here some student, sir, before amendment 1 lakh limit. Now how come you say 1.25? This 1 lakh limit, see in 112A section, 2 amendments happened. One is threshold limit. 1 lakh is increased to 1.25. That's a different amendment. Tax rate is increased from 10 to 12.5. Threshold limit for the entire year is 1.25 lakh. Remember this. So this is 112A. Sir, suppose same dates, sir. Transfer dates are same, but the asset is not long term. The asset is a short term. Then no threshold limit, no exemption. Straight away, we already know 112A gain is taxable at what rate? 15% before amendment. Now the tax rate is increased to 20%. Same asset, same 3 assets. Listed equity shares, listed equity oriented mutual funds, units of business trust. These 3 I am selling. Before 23rd July you are selling. Yes sir. Short term, yes, 15% tax rate, flat 15. On or after 23rd July you are selling. Yes sir, flat 20%. Sir, I am getting a short term capital gain on some other asset, not these 3. Some unlisted debenture I am getting 50 AA. Sir, I am getting some unlisted bonds, 50 AA. Market linked debentures I am selling, short term capital gain. Depreciable assets block I am selling, short term capital gain. Land I am selling, short term capital gain. all other short-term capital gains are taxable at SSE specific rates, normal rates of tax. Normal rates of tax means what? For individual, HUF, AOP, BOI, AJP, slab rates. Company, firm, society, all them, company, firm, flat rates. Are you clear? That's it. 111A completed, 112A completed. Are you getting it? That's it. In 111A and 112A, you have even more, little more complications. Sir, shares if you are selling, no? STT must be paid both at the time of transfer and sale. At the time of purchase, at the time of sale, both the times. Equity oriented, at the time of sale, STT paid, that's enough. 112A section apply. Short-term capital asset, no. STT paid at the time of sale of that asset, that's enough. The sale might be happened before 23rd July, on or after 23rd July. You see, I have given tax rates clearly. Before 23rd July, 10% tax rate. On or after 23rd July, 12.5. Provided capital gain exceeding 1.25 lakh only taxable. And remember, this 1.25 lakh limit is for the full year together. That's it. Tax rates. Sir, if it is a short term, 15% of the transfer is before 23rd July, 20% of the transfer is on or after 23rd July. That's it. 112A is completed, 111A is completed. Whether an asset is a long term or short term, that is also completed. Are you clear? Yes or no? No. Now, there is another tax rate. Another tax rate which is 112, section 112 tax rate. Sir, I am selling some assets, sir, but not listed equity share, not listed equity oriented fund, not units of business trust. Some other asset I am selling. If it is a short term capital gain, straight away normal rate. What if it is a long term capital gain? What if it is a long term capital gain? Then that section, then that gain comes under 112. Then that gain comes under 112. Sir, I sold it before amendment, sir. Straight away the tax rate is what? 20% off on capital gain, computed after reducing indexed cost of acquisition. After reducing indexed cost of acquisition, I will get a capital gain rate. Straight away the tax rate is what? 20%. When? If the asset is transferred before 23rd July, before amendment. And you know the biggest amendment is, if at all I am transferring on or after 23rd July, straight away the tax rate is 12.5% without indexation. Straight away the tax rate is 12.5%, indexation benefit is removed. With effect from 23rd July 2024, if you are selling any asset, no indexation benefit at all. No indexation benefit at all. Straight away indexation is removed. However, if I am selling land and building, when I am selling on or after 23rd July, I am selling land and building on or after 23rd July. But you know, I purchased them before 23rd July. But selling after 23rd July. The period of holding is more than 24 months. It's a long term. I got a capital gain. What should I do? What I should do? Very simple. You should compute capital gains. Remember, this is very sensitive provision. You should compute capital gains for land and building. Look at this. Suppose, sir, I am doing land and building. Pakka question will come on this. This is what I'm predicting. Pakka question will come on land and building. Computation problem. Suppose I am selling a land and building, sir. When are you selling this land and building? Some, 20th August, or else let us do this point. Sir, I am selling this land and building after 23rd July 2024. I am selling this after 23rd July 2024. But when this is purchased in 2019 or 20, I purchased it, sir. Now, this is a long term, right? Because more than 24 months. By the way, for land and building, before amendment, after amendment, holding period logic is same, 24 months. More than 24 months, it's a long term. Yes. How you should do computation, full value of consideration, how much you calculate. Minus transfer expenses you reduce. Then you will get what? Net consideration minus indexed cost. Never. Because you sold it on or after 23rd July. So cost of acquisition without indexation, cost of improvement without indexation, balance is capital gain. It may be long term or short term. Now, you need to pay tax on this, right? Now, when you are computing tax amount on capital gain, individual and HUF, the two resident individual, resident HUF, they were given one option. Resident individual or resident HUF, they both were given one option. What option they were given? Sir, I was a resident individual. These people purchased this land before 23rd July, but are selling this after 23rd July. Indexation is lost. This is a very big negative thing for them. So what the government did, the government told them, you compute capital gains without indexation only. Always computation of capital gain for total income purpose must be without indexation. You should not consider indexation at all. But when you are computing tax amount, no. Computation of tax amount to time, once again compute long-term capital gain with indexation facility. Once again compute long-term capital gain with indexation facility. By the way, I need to compute long-term capital gain with indexation at what time? Tax computation time. On this, apply 20% tax rate, and how much is the tax? Identify. Already you computed long-term capital gain without indexation, correct? Already you computed, right? This amount copy paste here. On the 12.5% you apply. How much is the tax amount you are getting? Where the tax amount is low, that option you will choose. This will be applicable for whom? Only resident individual, only resident HUF, selling land or building or both on or after 23rd July, which they purchased before 23rd July, which is a long term. See, if it is a short term, I don't have any problem. Straight away taxable at normal rates. Since it's a long term, I have a question. Getting it? So first compute capital gains. In the answer problem computation, compute capital gains. In ICI book, there is a test your knowledge question number 6 or 7. Fantastic question. Same. Whatever I told as it is, you apply, you will get the answer. Are you clear? All of you. This is for land and building. Okay. Suppose, sir, this land and building is sold by some other person, sir. Land and building is sold by some other person. Any other SSE is selling this land and building. When it is sold before 23rd July, straight away take indexation, compute capital gain, tax at 20%. Even resident individual, resident HUF, if at all they are selling before 23rd July, take indexation benefit, compute capital gain, compute tax at 20%. Suppose we are selling after 23rd July, then individual and HUF, compute capital gain without indexation. At the time of tax computation, you should apply this logic. And any other person, they are selling land and building or both. A company is selling, a partnership firm is selling, a partnership firm is selling, a non-resident is selling, which is situated in India. Land is situated in India. He is selling it. After 23rd July, straight away compute capital gains. Straight away compute capital gains without indexation. Capital gain multiplied by 12.5% is the tax. No option scheme, no options like this. Option scheme is available only for resident individual and HUF. Remember, that's it. In regular class, I told you here also with indexation, without indexation, some logic also I told. 54 logic I told. More than 2 crore capital gain, here less than 2 crore capital gain. Without indexation, if you compute capital gain, maybe more than 2. That time investment in only one house is considered. What if SSE purchases 2 houses? And okay, we computed more than 2 crore logic. We did that logic. Remember the one logic I told? Yes or no? Yeah, that is enough in regular class. Here it is not possible to discuss. That takes a lot of time. Okay, but anyhow, if at all I'm covering, when I'm discussing 54 series, that time I'll tell you this. Until now, clear? Easy or not? You're able to reconnect everything? You're able to recollect everything? Yes or no? Fine. Fine. So this is regarding land and building. Suppose, sir, I am selling some other capital asset, sir. Not land and building. Some other capital asset I am selling. Some other capital asset I am selling. Not covered in 112A. But long term. Not land and building. If you are selling them before 23rd July, 20% tax rate with indexation. If you are selling on or after 23rd July, 12.5% tax rate without indexation. And remember, you need to compute capital gains as per 48 format for all non-depreciable assets. As per 48 format as for all non-depreciable assets. So what is the 48 format is all about? You see here. How to compute capital gains for non-depreciable assets. Computation of capital gains under section 48, non-depreciable assets. Other than depreciable assets, nothing but. Okay, for them how to compute? First, you should always follow this format in the exam. You should always follow this format. Okay, so full value of consideration, how much? Identify. Full value of consideration, how much? Identify. What is full value of consideration? Full value of consideration can be actual amount or deemed consideration, which may be as per 50C, 50CA, 50D. Actual consideration or deemed consideration as per these sections, whichever is applicable, whichever is applicable. We'll discuss that later. Okay, full value of consideration, find out. Reduce transfer expenses. Remember, transfer expenses generally will be calculated as a percentage of actual consideration, or they'll give you straight away the amount. Reduce that. What you will get is called as net consideration. Then from that you have two deductions. One, cost of acquisition, cost of improvement. Suppose if this computation you are doing, if at all you're doing this computation before 23rd July and the computation is for a long-term asset, then indexed cost of acquisition, indexed cost of improvement. Remember, if at all you are computing on or after 23rd July sale, indexation benefit itself will not come. Sir, but you told no individual HUF, resident HUF for land and building. That is a tax computation time you do. Original long-term capital gain computation indexation will not be there at all. With effect from 23rd July, if you are selling, it's a long term. On or after 23rd July you sold, indexation itself is not available. Straight away cost, actual cost you reduce. Then what you will get? Gross long-term capital gain. Then from that, reduce exemptions under 54. What is 54(6) exemption? Will come back. Then balance taxable capital gain you will get. Now, what is full value of consideration is the question. What is full value of consideration is the question. Okay, we will discuss now one by one here. Full value of consideration is what? Cost of acquisition means what? Cost of improvement means what? Indexation benefit, how to claim before amendment, how to claim indexation, after amendment, how to claim indexation. All that we will be discussing one by one. So now I will cover full value of consideration. Okay, now I will cover full value of consideration. What is full value of consideration? There is a section called 50C. Remember what is full value? Remember, many students they will write sale consideration word. When they are computing capital gains, actual sale consideration they will write. You will lose half mark there. You should never use actual sale value like that. You should always use full value of consideration. What is full value of consideration? Very simple. Suppose, sir, I am computing capital gains because I am transferring immovable property. I am computing capital gains on transfer of immovable property. Okay, you are transferring immovable. So what is consideration? Consideration is, this logic should be applied. Stamp duty value, identify. In the problem, they will give you stamp duty value. They will give you two stamp duty values in the problem. Stamp duty value on agreement, stamp duty value on registration of this land and building which you sold. Both the dates they'll give you. Which date we should consider? We'll come back. Stamp duty value first to see. Is it more than 110% of actual consideration? Identify. Suppose actual consideration 810 lakhs. 810 crore. Actual consideration is what? 810 crore. Stamp duty value is 890 crore. Stamp duty value is what? 890 crore. C is 890 more than 110% of 810. Check out. 110% of 810 is equal to 891, sir. No. Stamp duty value is not more than 110% of actual. Since stamp duty value is not more than, does not exceed 110% of actual, full value of consideration is actual, which means 810 only we will take. In the computation we will take only 810. Sir, suppose stamp duty value is not 890, sir, but 900, sir. Stamp duty value is not 890 but 900. Okay, apply the same logic. Is 900 more than 110% of 810? Yes. If that is the case, then stamp duty value itself is full value. Then 900 I will take. Understood or not? No. Sir, stamp duty value I understand. If stamp duty value is more than 110%, stamp duty value. If stamp duty value is not exceeding 110% of actual, then actual. This is the consideration I should take. I understood. Stamp duty value means what? On which date we should consider? Stamp duty value can be either date of agreement or registration. Which is applicable we should see. Suppose to sell this land and building, is there any agreement entered into by you? Yes, agreement is entered, sir. On the date of agreement or before the date of agreement, have you received advance? Yes, sir, I received, sir. How will you receive the advance? Other than cash. In 40A3, some modes are given. Remember 40A subsection 3 PGBP, more than 10,000 in cash, that PGBP. Beam, UPI, credit card, debit card, check, account pay check, account pay draft. In 40A3 modes I received, sir. Advance I received in 40A3 mode. Other than cash I received, sir. Not bearer check, not crossed check, not bearer draft. Remaining all other electronic modes, banking modes, I received. When I received advance, agreement date. then stamp duty value on agreement date shall be taken. Suppose, sir, I don't have any advance, sir. Agreement itself is not there, sir. Then stamp duty value on the date of registration value you should compare. Sir, advance is there, but in cash. Stamp duty value on the date of registration. You see, advance received from buyer on or before date of agreement by other than cash, agreement date. Sir, advance received in cash, sir, date of transfer STV. No advance at all, sir, date of transfer STV. Are you clear? Yes or no? Full value of consideration you should decide like this for removable property. Sir, suppose I am selling, here I have given an example. You see this example later. You download this PDF and then see that later. You can order this book also on the website. Okay, fine. So full value of consideration in other situations. What is full value? Sir, unlisted shares I am selling, sir. Suppose unlisted shares I am selling. In the problem, the moment they give you unlisted shares, see what is the market value. Actual consideration is, let us assume, sir, 10 crores, sir. Market value 12 crores, sir. Market value shall be taken. Sir, any other asset I am selling, sir. Not unlisted share, not land and buildings, sir. Some other asset I am selling, sir. And you, some other asset, what is the consideration? Always actual. However, if consideration cannot be ascertained, if consideration cannot be, somehow we are unable to ascertain consideration, sir. It's a case of exchange, sir. We are unable to identify how to determine what consideration. Then market value of the asset transferred you take. What you transferred, it has a market value, take that as a consideration. You got in return some non-monetary benefit you got. You don't know how to value that. What you gave has a market value, consider that. That's it. Full value of consideration is over. Clear all of you? So once full value of consideration is computed minus transfer expenses, you will get net consideration. Then from that you should reduce what? Cost of acquisition. Now you see again. Now full value, we understood how to compute full value. Land and building, stamp duty value more than 110% of actual is equal to stamp duty value. Otherwise actual. Unquoted shares, market value more than consideration, then market value. Any other assets, actual consideration which will be given in the question, that only you will take. If actual consideration is not determinable, market value of the asset transfer. Minus transfer. Transfer expenses means what? Expenses which are exclusively related to sale of that capital asset, like brokerage, stamp duty, registration fee, legal expenses, all that. STT paid will never be treated as transfer expenditure. STT paid, suppose you are selling shares, you are selling listed shares. STT payment information is given. Never consider that. Never consider that. Understood? Then once you reduce from FVC, transfer expenditure, what you will get is net consideration. From net consideration, what deductions are there? Cost of acquisition, cost of improvement. That's it. Once we cover cost of acquisition, how to decide the cost of acquisition, there once again I will discuss period of holding, cost to the previous owner, 49 subsection 1 modes, like that. So much discussion is there. Once we complete that, I'm telling you, predominantly capital gains chapter is over. Revision. Now you see, you're able to reconnect everything. Yes or no? That's the power of holistic revision. Getting it? When you see independently, you will feel so much is there. Your confusion. No. There is a structure in which you should revise. You understood until now? That's it. That's it. Okay. We'll continue in the next session, the remaining part of the revision. Okay. That's it. Yes. Let's continue the revision of capital gains. So we started discussing the capital gain computation for non-depreciable assets, and we already completed what? Full value of consideration, transfer expenses. Now let's look at the cost of acquisition and cost of improvement. Now what is cost of acquisition? Cost of acquisition means generally actual cost or deemed cost of acquisition, which will be determined as per section 49 and 55, which is as applicable. See, here in this book I gave a format in such a way that you have to present like this only in exam. So you should present like this. So full value of consideration, you should write in exam note number 1. If 50C, 50D, 50CA, something is applicable. Then transfer expenses point, you should write it as a note number 2. If at all you are computing any transfer expenses, or if you are ignoring STT paid, that and all. 3. Cost of acquisition. Whatever point provision is applicable, you should write it as a note number 3. This is how you should present in exam as it is. Getting it? Now, what is a cost of acquisition? Deemed cost or actual cost, as the case may be determined as per 49 and 55. Correct? As per 49 and 55. No deduction will be given towards interest on housing loan under 24B, 80EE, 80EA. Nothing but interest on housing loan is not a cost of acquisition or cost of improvement. No deduction for that. Indexation is available if at all capital asset is transferred before 23rd July. Remember, transfer date must be before 23rd July. Then only indexation facility will be available, which is what? Prior to amendment. Whereas if at all transfer is on or after 23rd July, straight away when you are computing capital gains, no indexation at all. However, if at all you are selling a land or building or both by an individual or HUF who is a resident in India, getting it, there also capital gain computation will be done without indexation. But for him, at the time of tax computation working, that time we should consider once again capital gain with indexation and apply 20% tax rate, without indexation and apply 12% tax rate. That's it. Now, earlier up to 23rd, if it is a long-term capital gain, tax rate is 20%. Now, long-term capital gain is tax rate is 12.5%. Getting it? Now, without indexation, on or after 23rd July 2024, no indexation at all. Now, sir, what do you mean by indexation? What do you mean by cost of acquisition, deemed cost of acquisition? All that we'll discuss. Look at this. Now, cost of acquisition means what? Cost of acquisition means what? The cost at which asset is acquired by the SSE or even previous owner. Previous owner cost means what? If the asset is received by SSE under the modes specified under section 49(1). I clearly discussed in the later topics. Okay, fine. What is cost to previous owner discussion? We'll come back to it little while later. Now, whatever cost of acquisition is there, right? If at all you are transferring, before amendment, if at all you are transferring before amendment, before 23rd July, if at all the asset you transferred is a long-term capital asset based on period of holding, then that asset cost of acquisition can be indexed. That asset cost of acquisition shall be indexed. Indexation is nothing but inflation benefit. So cost is given an inflation benefit. To the extent of inflation in the acquisition cost, income tax department don't want to tax you. That's the logic. Now, what is the, how to calculate indexation? Indexed cost of acquisition is equal to, look at the cost. What is cost? Cost may be actual cost or deemed cost as per 49 or section 55, as the case may be. As the case may be. We will come to this cost of acquisition discussion little while later. Cost of acquisition multiplied by index number of year of transfer. Index number of year of transfer. Remember, here you must use year of transfer. For example, you know, as per the charging section, like I have not yet covered charging section till now. Getting it? As per the charging section, capital gains will be computed in the year in which transfer takes place. However, there are three sections: 45 subsection 2, conversion of capital asset into stock in trade; 45 subsection 1A, destruction, demolition of capital asset and insurance compensation received; 45 subsection 5, compulsory acquisition of capital asset by the government. In these cases, computation of capital gain will be done not in the year of transfer, but in the year in which consideration is received, in the year in which actual consideration is realized. Getting it? That is when computation of capital gains will be done. For example, an asset is destroyed, or an asset is converted into stock in trade, or an asset is compulsorily acquired by compulsory acquisition. All this happened in 24-25. All this happened in 24-25 or 23-24 or 22-23. Look at the date on which it happened. Before 23rd July. Yes, if it is before 23rd July, the conversion happened before 23rd July. 23rd July 2024. Before 23rd July, destruction happened. Before 23rd July, compulsory acquisition happened. But amount is received in 25-26 or 26-27 some other time. Computation of capital gains, taxability of capital gains will be in these years. Taxability of capital gains will be in the year of realizing the money. But numerator, when you are computing indexation, for the purpose of numerator index number, by default many students accidentally take whatever the year in which they are receiving compensation, right? That year index number they will put. That's wrong. You should put the index number of the conversion year. You should put the index number of the destruction year. You should put the index number of the compulsory acquisition year. Once again, I will repeat that when I am revising 45 series. Getting it? So year of transfer means what? Year of sale, year of exchange, year of relinquishment, year of exchange, year of extinguishment, year of conversion into stock in trade, year of destruction, year of compulsory acquisition. That's what year of transfer. So that number you should put always denominator. Denominator. Very simple. When you got the asset into your hand, you are an SSE, right? When you got this asset into your hand, sir, I got asset into my hand somewhere, you know, on or after 2001 or 2002, sir. Getting it? Simple. When the asset came into your hand, that year index number you should put, or for us indexation facility comes only from the 1-2 financial year, 2001 2002 financial year. So that is a base year. So index number cannot be before 2001-2. Suppose you purchased the asset in 98-99, you purchased the asset in 95-98, you purchased it in 90-70-90-71. It doesn't matter. Index number of 2001-2 we will use. Suppose you purchase the asset in 3-4, you purchase the asset in 10-11, you purchase the asset in 2-3, 2002-3, nothing but after 1-2. After 2001-2 year you purchased, then that respective year number we will put. So 2001-2 onwards, whenever you purchase the asset, that year number will be given. If at all you purchased the asset before 2001-2, then 2001-2 number will be given. Very simple. So CII, index number for the year, first held by the SSE. First when you are holding this asset. So what do you mean by first held by the SSE? There is a contrary Bombay High Court judgment in Manjula Jesha case, which we will discuss a little while later. Getting it? Index number of the first held by the SSE. First time you are computing capital gains for some SSE, right? In the problem they'll be given. This asset is sold by so and so. Who sold it? In his hand, when the capital asset was received, when the capital asset was acquired, that date you should see. Accordingly, that year index number only you should put. First held by the SSE means the year in which the asset came into the SSE control. And you remember, you are computing capital gain for that SSE only. Getting it? That's it. Then, same way, see, once you get an asset, you might have done some improvements to it. For example, you purchased a land, that's acquisition cost. Later you constructed a building, that's an improvement cost. Later that land and building together is sold. The land and building together is sold in 2024-2025. What you sold? Land and building. But actually what you acquired originally? Land. What you constructed later? Building. Land cost is treated as acquisition, building cost is treated as improvement. Now improvement is also eligible for indexation. Remember, indexation will come only for long-term capital assets. That too if the transfer is before 23rd July 2024. Now how to calculate indexed cost of improvement? Simple. What is the cost of improvement? Identify. What is the index number of year of transfer? Same numerator. Denominator. In which year index CII of the improvement year. Add the word CII of the improvement year. In which year improvement has been incurred? Which financial year? That financial year index number you should put. That's it. Clear? Next. So now remember, indexation facility is not available even before 23rd July. Even if the transfer throughout the entire income tax life cycle, if you see, indexation is not at all available on these assets. What are they? Bonds and debentures. They are not at all eligible for indexation. They don't eligible for indexation. And however, capital indexed bonds and sovereign gold bonds, even electronic gold receipts, these are all eligible for indexation. Remember, I actually used the word highly volatile assets, but let us not use the word highly volatile assets. Better use the word assets covered under 112A. Let us use the word assets covered under 112A, where 112A taxation you are doing. Suppose if you are computing tax under 112A or 111A, listed equity shares, listed equity oriented mutual fund, units of business trust, for them you know indexation at all. And already remember, if you see 50AA just to be covered, you transfer of specified mutual funds, market linked debentures, depreciable assets. In all these cases, computation itself is in a different way. There the short term, the gain is always treated as short term. Yes or no? Depreciable assets 50-50A, units of specified linked mutual funds 50AA. Under them, if at all you are computing capital gains as per 50 series computations, entire 50 series computation, no indexation at all. If you are computing capital gains under 48 series or 46 or 46A, indexation is available. 50 series, if at all you are computing capital gains as per 50, 50A, 50AA, 50B, slump sale, no indexation facility at all. Able to understand? Thumb rule you can remember like this easily. Then sovereign gold bonds and SGBs, yes, obviously that's what I told here. Eligible for indexation. Any other long-term capital asset like jewelry, land and building, archaeological collection, paintings, drawings, sculpture, all other types of land and all other types of capital assets which are not depreciable assets, where the computation is not as per section 50 series, which is not a debenture, which is not a bond, they are eligible for indexation. For example, listed preference shares, unlisted preference shares, unlisted equity shares. Getting it? Whether you call bonus shares, whether you call right shares, whether it is land and building, whether it is jewelry, they are all eligible for indexation. Don't remember what is eligible for indexation. Remember what is not eligible. Simple. Bonds, debentures not eligible. Computing capital gains under 50, 50A, 50AA, not eligible. Getting it? And 112A assets, not eligible for indexation, because their capital gains computation will be done as per 112A special rate. 1.25 lakh is up to basic exemption is available, so no indexation at all. Are you clear? Tell me, the concept of indexation itself comes when, if the transfer is before 23rd July. What if the transfer is on or after 23rd July? What if the transfer is on or after 23rd July? Straight away, no indexation at all. If the transfer is on or after 23rd July, not at all eligible for indexation. Any asset, jewelry, land and building, preference shares, equity shares, doesn't matter. No indexation at all. If the transfer is on or after 23rd July. However, for an individual and HUF who is a resident in India, for him also indexation is not available. He sold land and building, which he purchased long ago, but sold after 23rd July. Sold on or after 23rd July. Still, when you are computing capital gains, you don't consider indexation. Compute without indexation capital gain. We have in our test your knowledge question, ICA book, question number 6. Wonderful question. Okay, so compute capital gain without indexation. Then finally, when you are computing tax rate, if at all the SSE is a resident individual, resident HUF, he purchased this land and building long ago, before 23rd July, but sold on or after 23rd July, then we will give him an option to pay tax as per these two. One, compute tax liability at 20% on the long-term capital gain, where the gain amount has to be computed after considering indexation. Or on or after 23rd July, what is the long-term capital gain tax rate? 12.5%. Compute capital gain without indexation, which is what we did already. In the main problem solving, we always do without indexation. On that, apply 12.5% and see the tax. Whichever is lower tax, that option you will decide and pay tax accordingly. Remember, this is only tax computation step. This is not to be done in the problem computation. Are you getting it? That's it. So that is what we have given here. So only for income computation purpose, capital gain shall be computed without indexation. However, for tax computation purpose, indexation option will be checked to pay tax in a beneficial manner. That's it. Okay, indexation without indexation, all that is completed. Now remember, cost of acquisition. What is it? Cost of acquisition. Look at this format. What is this cost of acquisition, right? This cost of acquisition, sometimes this cost of acquisition has to be adjusted by. Sometimes this cost of acquisition has to be adjusted by forfeited amount. Sometimes the cost of acquisition has to be adjusted by forfeited amount. Very simple. See, generally, how do we compute capital gain, sir? Suppose I sold an asset for 10 crores, sir, minus cost of acquisition 5 crores, sir. From this cost, I should reduce forfeited amount. For example, forfeited amount 50 lakh. Balance cost is 4.5 crore. If at all this transfer is before 23rd July, this has to be indexed. Many students will do mistake if forfeiture point is given. What they do, you know, they index on this. They do apply indexation on this and they reduce this from the indexed cost. No. If at all forfeiture of advance is there, you should reduce first that from actual cost or deemed cost, as the case may be. Then balance cost, see whether indexation available. When indexation is available on the balanced cost, if the transfer is before 23rd July, indexation is available. If the transfer is on or after 23rd July, no indexation is available. That's how you should compute. If at all indexation has to be computed, indexation has to be applied on balance cost of acquisition available after removing forfeiture. Sometimes from cost of acquisition, forfeited amount if you reduce, cost might become negative. That time you should make it 0. That time you should make it 0. Able to understand. That's it. Very rare, very extreme rare cases. Now, sir, what is forfeiture of advance? Forfeiture of advance is very simple. Forfeiture of advance. Suppose I decided to sell some property and I entered into agreement with other person. He paid me advance. As per the terms, within 1 month or 2 months, he need to get registration. After paying the balance money, he didn't pay. He violated the contract terms and conditions and he is not interested to buy anymore. Whatever advance he paid me, I will forfeit either in full or in part. Okay, I will forfeit. Forfeit means what? I made a profit. Forfeit means what? I received an advance to sell the asset, but I didn't sell the asset. Nothing happened to my asset, but I made a profit because of the forfeiture. Because of the forfeiture, I made some profit. Now, what should I do with this profit? This is a question. Forfeiture of advance is a profit to the SSE. What should we do? It depends upon when you forfeited. That's what I told at the beginning of the class. 4 dates. In that, one of the date is 1st April 2014. One of the date is 1st April 2014. When you forfeited, I forfeited before 1st April 2014. If so, that amount shall be reduced from cost of acquisition like this. That amount shall be reduced from cost of acquisition like this. When you are computing capital gains ultimately on the transfer of the said capital asset. Same capital asset subsequently some other time you will sell, right? That time when you are computing capital gain, cost of acquisition, don't immediately reduce it. See whether any forfeiture is there in the question. See the date of forfeiture. If it is before 1st April 2014, reduce that from the cost of acquisition. Balance cost, reduce it from the consideration to arrive capital gain computation. Indirectly, the forfeited amount is not taxed in the year of forfeiture. Forfeiture amount is taxed ultimately in the year in which the asset is actually sold. This is the tax treatment if the forfeiture amount is before 1st April 2014. What if the SSC forfeited on or after 1st April 2014? On or after 1st April 2014, if at all you forfeited, it should be straight away taxed as income from other sources. It is straight away taxable under income from other sources. Which year? In the year of forfeiture, which is what a right way of taxing it. Getting it? So, if the forfeiture is, if the amount is forfeited on or after 1st April 2014, it will be straight away taxable in other sources. That's it. This is about section 51. Forfeiture before 1/4/2014, 51 section apply. Forfeiture on or after 1/4/2014, 56 section apply. That's it. Clear? Then, so we understood what is cost of acquisition. We understood what is indexed cost of acquisition. All that. Then, what is a cost of improvement? Let us look at cost of improvement aspect also, and then we'll finish. What is cost of improvement? Remember, I purchased some land, I already told. Then I constructed a building. Then I constructed additional floor. Then I constructed additional floor. Any capital expenditure you spent. Remember, any capital expenditure you spent on the asset after purchase, that capital expenditure is called as what? Cost of improvement. Able to understand. And remember, cost of improvement before 1st April 2001, nil. Don't take it. If cost of improvement is before 1st April 2001, don't take it. Remember, at the introduction I told 4 dates. One of the date is 1st April 2001. What is 1st April 2001 significance? I will tell you now. So, cost of improvement incurred before 1st April 2001, nil. Sir, improvement cost is incurred by previous owner, sir. Improvement cost is incurred by previous owner. I didn't spend it. I got this asset from the previous owner as per 49 subsection 1 modes. Then cost of improvement in my hands will be same cost how much my previous owner spent. Cost of improvement. Suppose, sir, I incurred improvement cost on or after 2001, sir. Previous owner incurred or I incurred. Any of us would have incurred on or after 1st April 2001. Whenever you incur, whatever the cost, that itself is the cost of improvement. 2001, 1st April 2001. And if any cost of improvement is given in the question that is spent before 1st April 2001, you straight away ignore it. Remember? Same way, one point I need to clarify. Section 51, forfeiture of advance is there, right? Advance forfeited by previous owner, ignore. Advance forfeited by previous owner. Sometimes in the problem, previous owner information might be given. Advance forfeited, that is not taxable in the hands of the SSC. In the hands of the SSC, no tax treatment on that. That's it. Clear? So, then, what is the cost of improvement for goodwill intangible? Straight away, nil. What is cost of improvement? Cost of improvement does not include routine repairs and maintenance. Any expenditure which is deductible under other heads of income. Any expenditure where you are claiming deduction under other heads of income, whenever you incur that. That is not treated as cost of improvement. Cost of improvement means something that is capital expenditure where you have not claimed a deduction till date. Now you can claim that expenditure as a deduction at the time of computation of capital gains. That's it. That's about cost of improvement. Clear? Next. Now let's discuss the actual main theme of the provision. Cost of acquisition. Remember, period of holding, cost of acquisition, 49(1). This modes we kept pending. If at all we discuss this and we discuss 46 and 46A, and if we discuss 54 series and 50B, over. The chapter is over. Able to understand? Now, what is cost of acquisition? What is cost of acquisition? You know, there are some circumstances where cost of acquisition has to be determined. What are the circumstances? What is the cost of acquisition? 49 subsection 1. If the capital asset became the property of the SSC under, if the capital asset became property of the SSC under the following modes. If, you know, I didn't buy the capital asset. I didn't buy the asset. See, I am selling the asset now, right? In the problem, they'll give you some asset you sold. That asset, no, not purchased by me. That asset was given to me as gift. That asset was given to me under will. You know, by an individual or HUF. By the way, here you remove this 31st March. Okay, this 31st March not required. This 31st March is relevant for ease of point. For this it is not relevant. Okay, leave it. Getting it? Gift or will by whom? Individual or HUF. Remember, now I need to even cover 47 section also. Now I need to simultaneously cover 47 section also. 45 subsection 1 is there, which is actually charging section. As per charging section, profits and gains arising on transfer of capital asset will be taxable in the year of transfer. So if you transfer any capital asset, when are you receiving money? Doesn't matter. Is there a profit on the transfer? Yes, that is taxable. In which year? Year of transfer. Now, what do you mean by transfer? There is a transfer definition which is given inclusive definition. That's not a big deal. What is capital asset? We will discuss. What is a capital asset? We will discuss. Now, what section 47 is there? There is a section called 47. Remember, 2 subsection 47 is transfer definition. 47 is exemptions from transfer. There is a logic between them. Getting it? There is a link. 2 subsection 47 is a transfer definition. 47 says which are not treated as transfer. What is not treated as transfer? There some list is given. Majority of that is copy pasted here also in 49 subsection 1. Getting it? Suppose, sir, I received a capital asset by gift or will from an individual or HUF, sir. From an individual or HUF, I got it as a gift. Or I got this asset in succession, inheritance, devolution. I got this asset on account of distribution, also not required. I got an asset on account of transfer to a revocable or irrevocable trust. I got this asset as a transfer between subsidiary company and holding company, 100% between them the relation, provided the transfer company is Indian company. Transfer of assets between amalgamation, transfer of assets between demerged company and resulting company. So these points are majorly enough. Mainly for us, individual taxation is what tested in exam. For us, mainly individual taxation is what majorly tested in capital gain. So individual related provisions alone, if you are strong at, that's more than enough. Getting it? Gift, succession, transfer of a irrevocable or irrevocable trust. These are all individual related provisions. If these 3 provisions, if you understand, that's enough. Sir, I got the capital asset as a gift, sir. I got it under will, succession, inheritance. Getting it? Now, what is the cost of acquisition? Because I didn't buy the asset. Cost of acquisition is cost to previous owner. What is it? Cost to previous owner. What is cost of acquisition? Cost of acquisition shall be cost of acquisition to previous owner. Your previous owner would have bought that, right, at some money. At what price he bought? That itself is treated as you purchased. That itself we treat it as you purchased it. Suppose, sir, my previous owner, he purchased it 95-96 year at 10 lakhs, sir. In 2007, 2008, I got inherited. Now, and I sold this building in 2024-25, sir. I sold it in 2025. So let us assume cost of acquisition is 10 lakhs. Okay, there is a market value concept on 1/4/2001. Okay, let's ignore for the time being. Just look at the provision. I am talking mainly here indexation point. Into numerator, index number 2024-25, 360 numerator. Denominator, when the asset is held 95-96. I told you when the asset is purchased before 2001, 2002 index number you should take. But remember, you should take 7-8 index number. You should take what number? 7-8 index number. Why 7-8 index number? Because this is the year in which you got the ownership of the asset. This is the year in which you first held. Indexed cost of acquisition formula, cost of acquisition into CII of the year of transfer divided by CII of the year in which asset is first held by the SSE or 2001 to whichever is later. Yes or no? But remember, all these cases are covered in another section, 2 subsection 42A. There is another section, 2 subsection 42A. What that section says, that is about period of holding. That section says period of holding. What that section says at the introduction will go. At the introduction of the chapter only it will be there. Yes, you see. If you remember, we already completed, nature of asset, long term or short term, how to decide long term, how to decide short term, yes or no. We already completed. So when an asset is treated as long term, when an asset is treated as short term, it depends upon period of holding. Period of holding means what? From when I got the asset, when I sold it. That gap. If it is up to 12 months, it's a short term. If it is up to 24 months, it's a short term. In case of before amendment, up to 36 months logic is also there. Then also it's a short term. Suppose if the holding period is more than 12, more than 24, more than 36, as the case may be, then it's a long term. And remember, after amendment, we have only two criteria: 12 months, 24 months. That's it. Beyond 12 months, it's a long term. Beyond 24 months, it's a short term. Now, what are the assets considered for long term? Listed securities, units of equity oriented mutual funds, units of Unit Trust of India, zero coupon bonds. Any other assets, 24 months is the criteria. Correct? Now, when you're determining, when you are computing period of holding, generally period of holding will be considered from date on which I acquired the asset till the date on which I sold it. But there are some cases where previous owner holding period will be considered. Previous asset holding period will also be considered. What is previous owner holding period? Previous asset holding period. Both will be considered. Now, look at this. For example, assets became property of the SSC. Asset became property of the SSC by 49(1). 49(1) means what? Gift, will, inheritance, succession, succession, inheritance, conversion of HF property into individual property. In all these cases, 49 subsection 1. Getting it? I will once again repeat in 47. In 47, we will get the same points once again. If at all you are getting asset into your hand by you are not purchasing. Somebody purchased and you received the asset as an inheritance, as a gift, as a will. Then previous owner holding period shall also be considered. Very simple. My father purchased asset in 2023-24. Some land he purchased. In 2024-25, I inherited. What is it? I inherited. And I sold the land immediately. Now, don't say the gap is less than 24 months. Because you inherited when 24-25. Very simple. Very simple. For example, my father purchased the land on 1st October 2022. Okay, he purchased a land. So, who purchased it? The previous owner, father purchased. Later on 30th March 2025. 30th March 2025, it was gifted to me, and on the same day I sold. On the same day I sold to somebody else. Now, what is the holding period for me? Asset when I got 30th March. On the same day I sold. Means one day only I am owner. One day only I am owner. It's a short term. No, you should not compute like this. Since you got it as a gift, inheritance, succession like that, when previous owner purchased 1st October, from the date till the date you sold, till the date you sold, from the date when your previous owner purchased till the date when you sold, this period is considered as period of holding by you. This period is considered as period of holding by you. Are you getting it? Now, he purchased in 1st October 2022 and I inherited on 30th March and I sold it on 30th March. Let us assume inheritance, this is sale date. This is sale date. I inherited on 30th January, let us assume. I inherited on 30th January. I sold it on when? 30th March. Generally, period of holding means what? When I got the asset, 30th January. When I sold it, 30th March. The holding period is 2 months. Since it is less than 24 months. Since it is less than 24, we naturally think what? It's a short-term capital asset. Wrong. This is not how you should do. Generally, period of holding means these 2 dates only. That is correct. Suppose on 30th Jan only I purchased the land. Then I sold on 30th March. Period of holding is 2 months. Perfect. But you didn't purchase it. You got it as a gift. You got it as a will. You got it as an inheritance. You got it as succession, which is covered under 49 subsection 1. Which is covered under 49 subsection 1. Then what is cost of acquisition? Cost to previous owner. My father purchased it at 10 lakhs. What is period of holding? Don't compute it from when you purchased it. When you got it, compute it from when your previous owner purchased. Remember, you didn't buy, you just got it as a succession, you just got it as an inheritance, you just got it as a gift. Getting it? When they bought, 1st October they bought. So from 1st October 2022 to ultimately when you sold 30th March 2025, what is the time period? More than 24 months. Therefore, it's a long-term capital asset. Therefore, it is a long-term capital asset. Able to understand? Therefore, it is a long-term capital asset. Now, since it's a long-term capital asset, when you are computing capital gains, indexation is available, right? When you are computing capital gains, indexation is available, right? If at all indexation is available, cost of acquisition is what? Cost to previous owner. My father purchased it 10 lakhs. So, cost to the previous owner into numerator, index number of year of transfer, in which year you transferred, 24-25, 363. Denominator, in the year, index number of the year in which first held by the SSE. Array, I also got this as inheritance in 24-25 only, 363 only I'll put. New denominator also what number I'll put? 363. Therefore, 10 lakhs only indexed cost. However, Manjula Jesha High Court, there is a court case called Manjula Jesha Bombay High Court case. What that case is, you know, when you are considering holding period, when the previous owner purchased, that year onwards you are considering, right? Then why can't indexation be claimed from that year? That's a logic. Where the High Court says it is absolutely logical. Where the High Court says it is absolutely logical. 10 lakhs multiplied by 363, the year in which you sold the asset, denominator, from when we are computing period of holding for you, 2022-23 onwards. In this example, in our example, 2022-23 onwards, we are considering period of holding. From that year onwards, you should consider indexation. So 2022-23 index number, whatever is there, put that index number. This should be given as an alternative answer in your exam. In your exam, don't write this as a main answer. Write it as an alternative answer. Must and should you should write. In the note point, I told right how to present the capital gain problem. In the note point, cost of acquisition. Alternatively, indexation can be claimed from the year in which previous owner acquired the asset or 2001 to whichever is later. Yes or no? When the previous owner acquired, as per Manjula Jesha Bombay High Court judgment. Understood or not? Everybody, that's it. Now, so if at all asset became property of the SSA under 49(1), previous owner holding period, cost shall also be cost to previous owner. Suppose I purchased it, sir, I didn't get it from anybody, I earned hard-earned money, I purchased it. Then when you purchased, from that date only holding period, whatever the cost you paid, that is only cost of acquisition. Simple, able to understand. Next, sir, inventory is converted into capital asset. Remember, it's not vice versa. Capital asset is converted into inventory. No, not that. I'll do one thing. I will discuss this at a time at 45 subsection 2. I will directly discuss at a time at 45 subsection 2, because conversion of capital asset into inventory, how to tax it. Conversion of inventory to capital asset, what's the tax treatment? Both I will discuss at a time. Yes or no? Now, shares, financial assets. Right shares, bonus shares means what, you know? I directly got from the company. See, when I purchase in open market, is it called as a bonus share? When I purchase in the open market, is it called as a bonus share? Secondary market? When I purchase in secondary market any right share, is it called as a right share? No. When the word bonus and right will used in the before a share, only when it is directly allotted by company. If shares are allotted by the company directly to me, period of holding will be considered from date of allotment. Same way, specified security, sweat equity shares, we will consider only from the date of allotment. Right renouncement. What is a right renouncement? I'll do one thing. Right renouncement, right shares, bonus shares, cost of acquisition, holding period, both I will discuss at cost of acquisition. 55 section is there, right? Special circumstances cost, there we will discuss. Okay, then electronic gold receipts, conversion of gold into EGR, conversion of EGR back into gold. In all these cases, period of holding of gold, period of holding of EGR, both will be considered. So what is this EGR taxation? Very simple. Okay, suppose I have a physical gold. Mr. Ram is having something called physical gold. He converted this into electronic gold receipt. This gold was purchased by him on 1st January 2020. He purchased it on 1st January 2020 and he converted into EGR on 2nd February 2023. He converted into EGR on 2nd February 2023. Now this EGR is sold. This EGR is sold, let us assume on 4th August 2024. 4th August 20. Let us apply 4th July. Better. Let's apply 4th July. It was sold on when? 4th July. Now 4th July. I sold EGR at 20 crore. You know, at the time I purchased, it was 5 crore. At the time when I purchased the gold, it was 5 crore. At the time when I sold this EGR, it is 20 crore. Now, what I sold actually? EGR. What is the full value of consideration? 20 crore EGR. Minus what is the cost of acquisition? Cost of acquisition of EGR is nothing but cost of acquisition of gold, which is 5 crore. Now you got a capital gain which is 15 crore. But you should not do like this. First you should see when the transfer date. Transfer date is on 4th July. The transfer date is on 4th July. 4th July means CII of the year of transfer divided by CII of year of acquisition of EGR. Acquisition of EGR. Remember, you know now how you acquired this EGR? Because you have a gold. Gold is converted into EGR. Able to understand? Now, whether this EGR is a long-term asset or short-term asset. By the way, what is the criteria applicable for EGR? Before amendment, 36 months. After amendment, 24 months. Before amendment is 36 months. After amendment, 24 months criteria is applicable. Now, sir, I got this EGR in 2023 February. I sold it in July 2024. Less than 24 months. Less than 24 or less than 36? Short term? No. When you are computing EGR holding period, gold holding period also should be considered. That's what, conversion of gold into EGR include the period for which such gold was held prior to conversion into EGR. When I purchased this gold, actually 1st January 2020, I sold ultimately EGR when 4th July. The gap, if you see, more than 36 months, because the transfer happened before amendment date. Because transfer happened before, in this example, transfer happened before 23rd July. Therefore, 36 months is the criteria. More than 36 months is a long term. So, accordingly, indexation is available. CII of year of transfer 24-25 and CII of the year in which asset is first held by the SSC. EGR is purchased when 22-23. 22-23 number you should put. But as per Manjula Jesha case, you can put 1920 number. As per Manjula Jesha case, you can put 1920 number also. Are you clear? All of you. Now, sir, EGR I sold, right? Somebody else purchased EGR, sir. Somebody else purchased EGR. When I sold EGR, actually I sold EGR to, some beam. I sold EGR to beam. When I sold 4th July, I sold, sir. 4th July 2024, beam purchased this. Yes or no? Now, he went and redeemed the EGR with the gold. He went and redeemed the EGR with gold. When he redeemed, 10th August 2026, he redeemed it on 10th August 2026. And remember, conversion of EGR into gold is not a transfer. It's not liable for capital gains tax. Conversion of EGR into gold is not a transfer. You're not getting any money. You're just converting. EGR is a digital gold. You're now converting into a physical gold. That is not taxable. Now, you converted into gold, right? You converted into gold. Who beam converted into gold? He purchased EGR from RAM and later converted in 2026 August into gold. Able to understand? Now, this gold he ultimately sold on 1st April 2027. He ultimately sold it on 1st April 2027. Or else 1st April 2028 he sold it on. 1st April 2028. He sold at what price? 30 crore. When he purchased, he purchased at 10 crore. He purchased at what price? 10 crore from RAM. Later he converted into gold. At the time when they converted into gold, that time market value of the gold is what? 15 crore. They will give you all this information in exam, but you should avoid it. Conversion of EGR into gold is not a transfer. This gold ultimately sold at what price? 30 crore. Now beam has to compute capital gains. Full value of consideration 30 crore minus cost of acquisition. He purchased at 10 crore, right? 10 crore. Is indexation available? Yes. Since no, indexation is not available. Indexation is not available. Why? He sold it when? He sold when the gold? 1st April 2028. Since the gold is sold after 23rd July 2024, indexation is not available. Moreover, what is the criteria for deciding this holding period? Long term or short term? 36 months or 24 months? 24 months. Because the transfer is happened on or after 23rd July. Remember, criteria for deciding long term, short term is not the purchase date, but the sale date. When the asset is sold, accordingly the logic has to be applied. Accordingly the criteria has to be applied. If the sale is before 23rd July, 36 months logic. If the sale is on or after 23rd July, 24 months logic. Able to understand? That's it. EGR taxation is also over. Easy. That's it. Now, there are some transactions which are not treated as transfer. There are some transactions which are not treated as transfer. What are they? Important points I'll cover. Any transfer of capital asset. By whom? Individual and HUF. Under a gift, will, or irrevocable trust is exempted. This is an important amendment. This is an important amendment which is applicable for the first time from 24-25 previous year onwards, which is applicable for the first time on May 25 exams, September 25 or Jan 26. Getting it? Earlier, transfer of capital asset by gift by any person is exempted. But now, gift given only by individual and HUF is exempted. Gift given only by individual and HUF is exempted. Before amendment, gift given of ESOPs, that is fully taxable. Suppose an employee is there, he got ESOP securities from the company. when he was allotted ESOP, no, at the time of allotment itself, it was taxable for him, right? At the time of allotment itself, it was taxable for him under income from salary. Market value on the date of exercising the option is the value which is considered for valuation of perquisite. Getting it? That itself is treated as cost of acquisition for him. Now later, when he gifted to somebody or sold to somebody, doesn't matter, gift or sale, doesn't matter, ESOP gifting is taxable. Normally, if you gift any asset, not taxable. It is not a transfer. But if you are gifting ESOP, which you got from company, if you are gifting it to somebody, it is taxable in the year of gift itself. Now, that gift taxing, ESOP gift taxing is there, right? It is removed now. It is removed now. Very simple. Transfer of ESOP under gift will is treated as transfer up to assessment year, nothing but up to 31st March 2024. It is treated as transfer up to 31st March 2024. Which one? ESOP gift is transfer. But if at all ESOP is gifted by you on or after 1st April 2024, and if you are individual and HUF, you are gifting ESOP securities which you got, still it is main provision only will apply. So you are just gifting a capital asset, you are an individual, you are a HUF, you are gifting something called capital asset on or after 1/4/2024, fully exempted, not at all taxable. Subsequently, the person who got the gift, right, he sold it. Then what is cost of acquisition for him? Cost to me. Cost to me is what? In case of ESOP, market value considered at the time of perquisite valuation, or the asset at which I purchased it. Able to understand? That's it. So gift provision has been changed. Under capital gain, gift transfers has been changed. Any gift from 1st April 2024 is exempted only if the gift is made by individual or HUF. Exemption also includes ESOP gifting. Before 1st April 2024, gift by anybody is exempted. However, gift by employee of ESOP and specified security is taxable if the gift is before 1st April 2024. Understood summary or not? That's it. Then these are all amalgamation subsidiary companies not required. In our regular class we detailedly discuss. That is more than enough. Next one, redemption of sovereign gold bonds is exempt. Redemption of sovereign gold bonds is exempted. But anyhow, this I will discuss when I'm discussing capital asset definition. Capital asset definition, unlike normally, generally we can start discussion with capital asset definition, but we didn't do that. We will discuss it last, because in revision, this is how the technique. In revision, what is the main focus on? Main focus is on understanding the entire application of the capital gains, understanding how to solve the problem, all that. Later on, this capital asset, what is capital asset, what is transfer, this and all nothing, because this everybody will understand. Point what they don't understand is holding period of holding to be how to consider, cost of how to consider, how to apply indexation, transfer date is when, before 23rd, after 23rd. This is where many will confuse. Able to understand. That's it. And you remember, conversion of gold into EGR and vice versa, both are treated as exempted transfers. Yes or no? Next, transfer of capital asset under reverse mortgage. What is reverse mortgage? I think I'm not explaining it. Getting it? Here one important point. If you are transferring a house under reverse mortgage to a financer, housing finance company or bank, whatever, the transfer is exempted. Further, when you transfer house under reverse mortgage, you get monthly sum amount or you get a lump sum amount under reverse mortgage. That entire loan amount received is also exempt from tax. Simple. Next. Now again, come back to cost of acquisition. Now let's come back to cost of acquisition. Cost of acquisition in specified circumstances. Cost of acquisition in specified circumstances. Now you remember ESOP, cost of acquisition of specified securities or sweat equity shares, which are referred under 17 subsection 2. 17 subsection 2 is talking about perquisite valuation. If an employee got ESOP or specified security under employee from the employer, now that asset later he sold it. What is the cost of this asset? At the time when you got allotment, no, perquisite valuation purpose, market value will be considered, right? That itself is cost of equity. The market value used for perquisite valuation. That's it. Now, sometimes shares and debentures is what you purchase. Later it will be converted into some deposit certificates or some other share. Then new asset cost of acquisition is what? Old asset before conversion, what is the cost? That one only. Same way, cost of acquisition of equity shares received on conversion of preference shares. Now you are selling equity shares, but I didn't buy this equity share. I actually bought preference share. Then cost of acquisition will be preference share. Holding period also will be considered from the date of purchase of preference shares. Yes or no? Then Then this one we understood. Amalgamation, demerger, resulting company points not required. From exam point of view, not that important, but read it. Once you read it, okay, in revision I'm not covering because there is much more valuable important content which I'm going to cover. Next, we already discussed enough in depth on regular class. In amalgamation, all these points we discussed enough in regular class. Next, now coming to cost of acquisition of property which is taxed under 56 subsection 2. Cost of acquisition of property which is taxed under 56 subsection 2. Very simple. Sir, I sold a land and building. I sold a land and building at 20 crore. Okay. How I got this land and building, you know, there are two methods. One, I got it as gift. Gift from relative. Gift from relative. Or I got it as a gift from taxable sources. From taxable. Sir, what is a gift from taxable source? Gift from relative is a non-taxable gift. Gift from anybody else is a taxable gift. Suppose I got it as a gift from my relative. That is exempt for me under other sources. This is covered under 49 subsection 1 for the purpose of capital gains. Whereas if I am receiving gift from somebody else, if I am receiving gift from somebody, 49 subsection 4 is applicable. What is applicable? 49 subsection 4 is applicable. What is this? Generally, I got an asset as a gift and I sold it later. Generally, what is cost of acquisition? You immediately say cost to previous owner. When you should apply cost to previous owner? I received this gift, right? That time it is exempt for me. That time it is exempt for me. Even the previous owner also, for a previous owner also, it is not taxable when he is gifting me because it is covered for him under transfer. For him it is exempted and for me it is exempted. Both. I am receiving the gift which is exempted. Later I am selling it. That time, what is the cost of acquisition? Cost to previous owner. Suppose, look at this situation. I got a gift from my friend or from somebody. I got from somebody, not a relative. That is fully taxable for him. For me, that is fully taxable for me. How much is taxable? Either stamp duty value or fair market value on the date of gift, which we will discuss in gift provisions. That much is taxed for me in other sources. 56 subsection 2. When it is taxed, whenever I got the gift, it is fully taxed for me as income. Now that land, I am selling it to somebody. What is the cost of acquisition? Not cost to previous owner. It is not cost to previous owner. Cost of acquisition will be when I got the gift, how much income is taxed for me? That income is treated as not even income. The value considered for calculating income under other sources. It is similar to perquisite. It is similar to ESOP perquisite. Is there a market value considered at the time of employment, at the time of allotment? Similar way, what is the market value of the capital asset considered? What is the stamp duty value of the capital asset considered when you received the gift? For taxation of gift under 56 subsection to clause number 10. That value is cost of acquisition. When the gift I received, that is taxable for me at the time when I received. Suppose when I received the gift, that time it is exempt for me. That gift is covered under 49(1) mode. Gift which I received is taxable for me. That gift is covered under 49 subsection 4. Many will confuse. In problem, suppose they gave you in 2021-22, a friend gave you a gift. That time stamp duty value is, let us assume 1 crore. He purchased at 10 lakh. And the same gift now you received, right? 24-25, you sold it for 5 crore. 99.99% student, full value of consideration 5 crore minus cost of acquisition, cost to previous owner 10 lakh they'll put. Wrong. Cost to previous owner is what? 1 crore. Why? At the time when my friend gifted me, the value of the gift is 1 crore. So that's it. Because since I received from my friend, that time it is taxable for me. That time it is taxable. And remember, if a gift received is under 49 subsection 4, previous owner holding period we will not consider. We will consider only from the date on which I received the gift holding period to decide whether the asset is a long term or short term. This is gift provision. Once again, watch it later. You will understand. Okay. Repeat mode. You watch it once again. You repeat it. You repeat the video. You will get it for sure. Absolutely. Next. Next. Cost of acquisition of inventory. All this I will come back to it. Okay. Then what is cost of acquisition of various assets under various circumstances? Sir, intangibles, straight away cost of acquisition shall be purchase price. If it is self-generated, straight away nil. Sir, I acquired the asset under 49 subsection 1, sir. Then cost of acquisition will be cost to previous owner. Suppose if previous owner cost you are unable to ascertain. When he acquired this asset, check it out. That time market value, take it, which is very rare, not that important. That note point is getting it. Then, sir, financial assets, sir. Let's talk about financial assets. What is the cost of acquisition? Original shares, which I directly bought from the company in IPO. Cost of acquisition is amount paid to the company. Right shares, sir, I directly paid to the company. Amount paid to the company. Bonus shares allotted, sir, cost is nil. However, if the bonus shares are allotted before 1st April 2001, then cost of acquisition will be fair market value on 1st April 2001 or actual cost, which is nil, whichever is higher. So naturally what will come? Market value. See, here there is a thumb rule in capital gains. If any capital asset is purchased by you or purchased by previous owner as referred under 49 subsection 1, if at all they acquired this asset before 1st April 2001, cost of acquisition is equal to actual cost at which they purchased before 2001 or market value on 1st April 2001, whichever is higher you can take. That benefit is given. That's a benefit. So cost of acquisition is equal to actual cost to the previous owner before 1st April 2001 purchased or market value on 1/4/2001, whichever is higher. Suppose you purchased, previous owner himself purchased in 2003 for after 1/4/2001, or you purchased it in after 2001, market value on 1/4/2001 is to be ignored. Market value has to be ignored. Further, suppose if it is a land and building, you purchased a land and building before 1/4/2001. Previous owner purchased a land and building before 1/4/2001. Whoever it is purchased, it's a land and building. What is the cost of acquisition for land and building? You see here, cost of acquisition for land and building is what? Cost of acquisition shall be, you see, cost of acquisition shall be market value on 1/4/2001 subject to maximum of stamp duty value as on 1/4/2001. So actual cost or FMV on 1/4/2001, whichever is higher you take, but it is restricted to stamp duty value on 1/4/2001 directly. Immovable property only stamp duty value maximum limit is there. Remaining all other assets, what is cost of acquisition, how much you paid, or market value on 1/4/2001, whichever is higher, you can take that. Getting it? Other land and building. Other land and building means what? See, if land and building is acquired before 2001, that land and building. Others means what? Acquired on or after 2001. Actual cost. Cost of acquisition shall be actual cost. Whether you purchase or previous owner purchase, whatever it is, actual cost. Are you clear? Next, bonus shares. Okay, so generally bonus shares cost is what? Nil. But if bonus shares are allotted before 1/4/2001, as I already told, general rule, cost 0 or market value on 1/4/2001, whichever is higher. That's it. And remember, since we are considering cost of acquisition itself is market value on 1/4/2001 of the asset, any improvement incurred before 1/4/2001 we are ignoring. Why are we ignoring improvement cost before 1/4/2001? Very simple. We are directly taking market value of the asset itself. Full asset market value we are taking on 1st April 2001. Full asset includes what? Improvement cost which is already incurred. So improvement expenditure before 1/4/2001 shall be ignored. Cost of acquisition, if asset is acquired before 1/4/2001 by you or previous owner, cost of acquisition shall be actual cost or market value, whichever is higher. Any asset it might be, but not for intangibles, not for depreciable. Intangible assets 1/4/2001 benefit is not there. Depreciable assets 1/4/2001 benefit is not there, because depreciable assets we go computation of capital gains as per block of asset. Are you getting it? 1/4/2001 benefit is not available if at all you are computing capital gains under 50 series. 1/4/2001 benefit is available if you are computing capital gain under 48, 46, 46A. Able to understand? That's it. Sir, what about bonus shares cost of acquisition? I already told, bonus shares cost of acquisition is always 0. However, there is another date which is very important. Before 1st February 2018 or 31st January 2018, where a landmark amendment happened. Now you know 112A section, right? In that, what are there? Listed equity shares, listed equity oriented mutual funds, units of business trust, correct? Listed equity shares, equity oriented units of business trust. Yes or no? You know, all these assets, no, once upon a time, if they are long term, capital gain is exempted fully under 10 subsection 38. Once upon a time, capital gain is fully exempt under 10 subsection 38. What if I am a shareholder? Listed shares I have, bonus, non-bonus, forget about it. Listed shares I have. I thought I bought it with a view to get an exemption. If it's a long term, capital gain is fully exempted. But suddenly in 2018, Finance Act 2018, what it says, with effect from 1st April 2018, with effect from 1st April 2018, 112A section is applicable. Capital gain is taxable at 10% that time. Right now, capital gain taxable at 112A is what rate? 12.5%. If the asset is transferred on or after 23rd July 2024, correct? So that time exemption is there. Suddenly exemption is withdrawn. Now everybody got furious. How come you can withdraw the exemption? Long-term capital gain is exempted. On that exemption only I bought the shares in the Indian company. Otherwise I would have not bought. All that they started arguing. So what the finance minister said, what the income tax department did, what the income tax act has been done. Don't worry. As on 31st March, sorry. As on 31st January 2018, see, from 1st February, exemption is not there. 112A section is applicable. As on 31st January, whatever market value is there, take it as cost of acquisition. Happy? Take it as cost of acquisition as on the market value. See, if at all you sold it before, on or before 31st January, if at all you sold it on or before 31st January, entire amount you got is exempt, right? Whatever market value there on 31st January, take it as cost. Indirectly, am I giving exemption or not? Indirectly, am I giving exemption? Take it as cost. You sold it later at 20 crore. Market value on 31st January of the bonus share is 10 crore. Take it as cost. 10 crore only tax me. Indirectly, what am I saying? After 31st January, any appreciation in the market value, that only I will tax it. Up to 31st January, any market value appreciation, I will not tax you. Correct? Yes or no? So, what is the cost of acquisition of any share? Not necessarily bonus share, I am telling you here. Any share, including bonus shares. What is the cost of acquisition? The cost of acquisition will be actual cost. For bonus, it is nil. Or market value on 1/4/2001. Getting it? If at all the shares were allotted before 2001, consider that. Compare that with market value on 31st January 2018 or actual consideration, whichever is lower. Getting it? So this second point you compute, first point you compute, whichever is higher. That will be taken as cost of acquisition. Whether it is a bonus share or listed equity share, it doesn't matter. Suppose you see listed equity share, equity oriented mutual funds, units of business trust, which are acquired before 1st February 2018. Cost of acquisition will be what? Higher of 1 or 2. Here actually nil accidentally printed. Leave it. Okay? Because you acquired it. Getting it? If it is bonus, nil will be there. If it is other shares, purchased one, purchase value will be there. Actual cost, market value on 1/4/2001. 2001 logic is applicable when if the asset is purchased before 1/4/2001. So whichever is higher, between these two, whichever is higher, you take that amount, compare that amount with market value on 31st January or consideration, whichever is lower. Able to understand. See, consideration, actual consideration means what? Suppose in 24-25 you are selling it. At what price you are selling? That consideration you should take. That consideration you should take. Able to understand. Now this consideration or step 1, whichever is higher. That's it. So minimum cost, how much they are giving? Minimum cost they are giving how much? You know, market value on 31st January. Indirectly by giving market value benefit, what are they telling you indirectly? Take that much exemption. Able to understand. All of you? That's it. Then capital asset received on distribution under liquidation. This I will discuss along with the liquidation. 46 section is there, right? That time I will discuss. Sir, any other capital asset, sir? I purchased it before 1st April 2001 or previous owner purchased it before 1st April. Very simple. Cost of acquisition shall be higher of actual cost, market value as on 1/4. That's why for bonus shares, anyhow, cost of acquisition is nil, right? Nil or FMV means FMV. Are you getting it? That's it. Then cost of the property in the hands of the previous owner cannot be determined. That's okay, not required. Already we covered this. Okay, not required. That's it. Cost of acquisition provision is over. Now remember 31st January fair market value. What do you mean by fair market value? As on 31st March, if it is a trading day for the share is trading on a stock exchange, then highest price whatever is there on the date. Suppose on 31st January that share is not traded or stock market is holiday on the day. Highest price on the preceding day. What if it is a unit, not a listed share, but it is a unit? Net asset value on the date of transfer. Net asset value on the date of transfer. That's it. Okay. To that extent, it is more than sufficient. This understanding is sufficient for cost of acquisition, cost of improvement, all that. Able to understand. That's it. So with this, cost of acquisition is predominantly covered. Period of holding is predominantly covered. Cost of improvement is also predominantly covered. Clear, all of you? Yes. Just 1 minute. Yes. Let's continue. Now we are discussing now 45 section. Let's cover 45 section. Generally charging we have in 45 these sections. 45 subsection 1, which is what? Charging section. 45 subsection 1a, which is actually destruction, demolition, yes or no, that one. 45 subsection 2, conversion of capital asset into stock in trade. 45 subsection 5, compulsory acquisition of capital asset. Then apart from that, we have two more cases, 46 and 46a. Correct? Once we cover all this, then we will think of, we will discuss about exemptions under capital gains. Okay, 54 series. Now, 45 subsection 1. What is 45 subsection 1? Any profits and gains arising on transfer of capital asset is exempt. Sorry. Any profits and gains arising on transfer of capital asset is liable for capital gains in the year of transfer. Whereas 45 subsection 1 says what? Suppose my capital asset got destroyed. My capital asset got destroyed and I received compensation from insurance company. I received compensation from insurance company. My asset got destroyed in when 22-23. Year of destruction is what? 22-23, and that is to be treated as year of transfer. That shall be treated as year of transfer. But you know what? Insurance company paid me compensation only in 24-25. Insurance company paid me compensation only in 24-25. When I will compute capital gains, 24-25 I will compute. We will compute capital gains in 24-25. So previous year 24-25 we will compute capital gains. Full value of consideration is equal to amount received. Full value of consideration is equal to amount received, this much. Okay, minus cost of acquisition. Since remember, destruction happened in 22-23. Year of year of transfer is before 23rd July. Nothing but indexation is available. Correct? Cost of acquisition into CII of year of destruction. Correct? Because year of transfer is treated as year of destruction. Denominator CII of year in which first held by the SSE. Year in which first held by the SSE. So that much. Able to understand? So this is how you should compute capital gains in case if you are receiving any compensation from insurance company on destruction of capital asset. Then 45 subsection 2. 45 subsection 2. Conversion of capital asset into stock in trade. Conversion of capital asset into stock in trade. What is the tax treatment for conversion of capital asset into stock in trade? Remember, we are converting capital asset into stock in trade, not stock in trade into capital asset. First, let's look at this scenario. If you are converting stock in trade into capital asset, it is treated as sale in PGBP. It is treated as sale in PGBP. It is treated as sale. Suppose I purchased this stock in trade. Whenever I purchase doesn't matter, but I converted on 10th August 2022. I converted into capital asset. In 22-23 previous year, in 22-23 previous year, market value on conversion is there, right? That is treated as sale value under PGBP. Charging section 28 itself says that market value of inventory converted into stock in trade on the date of conversion straight away treated as sale value in PGBP. No, very good. Sir, you converted in which year? 10th August. Now I sold it, sir. I sold it. When I sold it, 5th December 2024, I sold this. 5th December 2024, I sold this. By the way, what is this? It's actually jewelry. It's actually jewelry. Originally it is inventory. Now converted into capital asset. Finally it is sold when? 5th December. Now holding period shall be computed. Holding period shall be considered from the date of conversion. Holding period shall be considered from the date of conversion because the jewelry became capital asset for the first time only on 10th August 2022. So only from 10th August 2022 till 5th December 2024, gap is more than 24 months because I am selling when? 5th December. Capital asset is sold on 5th December 2024. Asset is transferred on or after 23rd July. So the criteria is what? 24 months. What if the asset is transferred before 5th July? Then the criteria is 36 months. If the holding period is less than 36, it's a short term. Otherwise, it's a long term. But since the jewelry is sold on 5th December, which is on or after 23rd July, 24 months is the criteria. I got this on 10th August, sold it on 5th December, more than 24 months. Therefore, it is a long term. Yes or no? Full value of consideration. You know, I sold it at 5 crore. At the time of conversion, it is 2.5 crore minus cost of acquisition 2.5. Indexation is not available in this example. Because transfer is on or after 23rd July. Straight away balance 2.5 is long term capital gain, which is straight away taxable at 12.5%. Correct? Why indexation? I transferred it on 5th December 2024. Huh? That is only for immovable property. Okay. So for immovable property, option scheme is there. For others, it is not there. Only for immovable property, individual or HUF only. At the time of tax computation, option scheme is there. For any other assets, no option scheme. Yes or no? Straight away, no indexation. That's it. So this is regarding inventory converted into capital asset. Now the question is, capital asset is converted into stock in trade. This is what covered in 45 subsection 2. You know, I purchased this asset in 2000. I purchased this asset when, you know, I purchased this asset in same dates. Let us take. I purchased this asset on 25th September 2022. I purchased this asset on 25th September, not September. Let us take April. Better. Let us take April. 25th April 2022. I purchased. You know, I converted this. 2021. I will take better. 2021. I converted this into stock in trade on 30th June 2023. 30th June 2023. I converted it into stock in trade. Okay. Remember, this is also jewelry only. Year of transfer is what? Date of transfer is what? 30th June, because that is the date on which capital asset lost its identity. Capital asset lost its identity when 30th June. So date of conversion is, you know, 25th April to 30th June. Getting it? So year of transfer is what? 23-24. Year of conversion is also 23-24. But that year it is not taxable. As per 45 subsection 2, conversion of capital asset into stock in trade is not taxable in conversion year. You know what? I sold this stock in trade. Ultimately in 24-25. Remember, what I sold is stock in trade. Directly PGBP head of income is applicable. At what price I sold? 10 crore. Sir, what is its cost? Sir, purchase price is what, sir, in business? What is the purchase price, sir, to compute business profit? Very simple. On conversion date, what is the market value? On conversion date, what is the market value? Market value is equal to, that time it is 5 crore. Market value on conversion date is how much? 5 crore. That itself is treated as purchase cost in accounting. That itself is treated as purchase cost in business. Balance 5 crore is business or profession related income, PGBP. Not only that. Remember, capital gains you didn't compute. You know, you purchased this at 1 crore only. Ultimately you sold it at 10 crore. Actually total profit is what? 9. How much you taxed in PGBP? 5. Remaining 4 should be taxed where? Capital gains. How it should be taxed? In capital gains, full value of consideration is equal to fair market value on date of conversion. What is market value on date of conversion? 5 crore. Then the conversion happened 23 or 24 or 23-24. When the conversion happened? 23-24. But you should compute capital gains in which year? 24-25. Because 24-25 is the year in which stock in trade is ultimately sold. Conversion of capital asset into stock in trade is not taxable in the year of conversion, but taxable in the year in which stock in trade is ultimately sold. That is most important. But remember, conversion of stock in trade into capital asset, when the capital asset is sold, is not relevant. Conversion year itself, PGBP income will be computed. Whereas conversion of capital asset into stock in trade, year of sale only in the year of sale of stock in trade, capital gains are also computed. There is a difference here. Yes or no? Now 5 crore minus, sir, what is the cost of acquisition? This I purchased at 1 crore. Balance 4 crore is capital gain. And remember, you converted in 23-24. Since the conversion is in 23-24, date of transfer is in 23-24. Before 23rd July. Before 23rd July means, jewelry means 36 months is the criteria. From purchase date to conversion date, if the gap is more than 36 months, then it's a long term. If it's a long term, indexation is available. If it is not a long term, indexation is not available because date of transfer means what? In this case, date of conversion, date of destruction, date of compulsory acquisition. Computation you might be doing in 24-25. When you are doing computation is not relevant. Date of transfer is relevant for indexation. Date of transfer is relevant for, date of transfer is relevant for determining whether asset is a long term or short term or period of holding, all that. Yes or no? That's it. Then 45 subsection 5. Compulsory acquisition of capital asset. Compulsory acquisition of capital asset. Compulsory, for example, no, in 2022-23 previous year, central government acquired my property under compulsory acquisition, either under law or by central government or by even RBI. Because of some reason, compulsory acquisition happened. Because of some reason, compulsory acquisition happened. When happened? It is 22-23. Okay, you know how much compensation decided? 100 crore they decided. My compensation, how much is decided? 100 crore. You know, I purchased this asset in 2019, 2020, I purchased it. This asset is purchased by me when? 2019, 2020. I purchased this at 20 crore. I purchased this at 20 crore. Government compulsorily acquired it 22-23. Compulsory acquisition is a transfer. How much is the full value of consideration? 100 crore. How much is the cost of acquisition? 20. Capital gain is what? 80. I will talk about indexation, don't worry. So 80 is the capital gain. When this computation we shall do? This computation we shall do when this 100 crore is released to me. Actually, this 100 crore is released to me when, you know, 24-25. It is released to me when? 24-25, which means capital gains tax I will not do in 22-23. I will do capital gains computation in 24-25. I will do capital gain computation in 24-25. Getting it? So in 24-25 we will compute. But remember, date of transfer is 22-23. Before 23rd July 2024. Before 23rd July 2024. For that asset, whether it's a long term or short term, it depends on 12, 24, 36. Accordingly, is it long term or short term, you decide. If it's a long term, indexation is also available. Index number in the numerator, 22-23 number you should put. Cost of acquisition, all that as usually whatever we discussed. Computation alone will be done in year in which you receive the compensation. Computation alone we will receive, computation alone we will do in the year in which it is received. Able to understand? Next. So 45 subsection 5 is also over. Easy or not? 45 subsection 5 understood? By the way, in 45 subsection 5 we have few more points. Wait, I will show you directly. Because you also have to see this book also compulsorily. Enhanced compensation part is there, right? Enhanced compensation. Enhanced compensation sometimes you might get. Enhanced compensation is taxable when in the year in which enhanced compensation is received. You know, you see, additional compensation is taxable in the year in which additional compensation is received. Original compensation is taxable in the year of receipt. Yes or no? But what is the date of transfer taxability? Applicability is when if a capital asset is acquired by central government under compulsory acquisition. What is cost of acquisition? Sometimes you also receive what? Enhanced compensation. Enhanced compensation is separately taxable at the time when that is separately received. For that, what is cost of acquisition improvement straight away? Nil. Yes or no? Now, sometimes 45 subsection 5, what happens? 20-23 government acquired. Compensation amount is not decided. Compensation amount is not decided. In 24-25 year, they paid me 50 crore money. So just keep it 50 crore. They paid me 50 crore. But compensation I don't know. Full value of consideration I don't know. Full value of consideration is decided when 25-26. 100 crore it is decided. Original compensation, how much it is decided? 100 crore. Now, since I already received in 24-25 50 crore. But in 24-25, even though I received, I can't compute capital gains because full value of consideration is not possible. Remember, in the entire capital gains chapter, if consideration cannot be decided, cost of acquisition cannot be decided, even though capital gains head of income apply, you can't compute capital gains. You can't compute capital gains. If you cannot compute capital gains, you can't pay. You no need to pay tax. That's a problem in the income. That's a problem in the act. Two situations: if consideration cannot be determined, or second one, if acquisition cost cannot be determined, you cannot compute capital gains. If you cannot compute capital gains, capital gain section itself will, capital gain head of income itself will not apply. Able to understand? Now see here, 45 subsection 5, 20 to 23 year government acquired, 20 to 23 financial year government compulsorily acquired, 24-25 I received compensation, but that's not the final compensation. Final, we also don't know how much it is, but temporarily advance they paid me. But in 25-26 original compensation 100 crore decided. Now taxability will be in 25-26 previous year. Transfer happened in 22-23 only. Taxability will be in 24-25 previous year. Able to understand? Same way, later additional compensation also given in 27-28. Then that year 27-28 it is taxable. Now in 25-26 100 crore is decided, right? 100 crore is consideration minus cost of acquisition. At what price you purchased it? 19-20 year I purchased it. Cost. Indexation if applicable, take indexation. Minus cost of improvement. Then you will get gross capital gain. Then what you will get? Gross capital gain. That's it. Able to understand. Next. Next. Now that is 45 subsection 5. Now let us discuss 46A, buyback. Let us discuss 46A, which is buyback. So what is buyback of securities? What is buyback of securities? Now buyback, no, the section is divided into two parts. Okay, one is buyback of specified securities, buyback of specified securities other than shares of domestic company, other than shares of domestic company. Shares of domestic company. What is it? Shares of domestic company. Buyback. Companies are doing buyback of what? Some securities they are buying back other than shares of domestic company. And buyback provision on domestic company shares. So what is the provision? Buyback of specified securities by the company. Simple. My shares in the hands of shareholder, it is taxable. In the hands of shareholder, it is taxable. What is full value of consideration? Buyback amount. How much amount you are getting in buyback? Minus what is cost of acquisition? You purchase the shares at the time of purchase. Whatever is there, you reduce it. Then balance is long-term capital gain or short-term capital gain depending upon the holding period. Over. Able to understand? Suppose if it is a shares of domestic company, listed, unlisted, whatever, listed, unlisted of domestic company. Getting it? If the domestic company is buying back, here is an important amendment. When the buyback happened, is it before 1st October 2024 or on or after 1st October 2024? You should check out 1st October 2024. Is it before 1st October 2024 on or after 1st October 2024? I think dates, when I'm telling you 1st October 24 also I wrote, I guess so. Four dates I think. This 1st October also I mentioned. So before 1st October 2024, if at all any buyback happened, you got money, right? Your shares are cancelled, right, on buyback? Nothing. Fully exempted. What is it? Fully exempted under 10 subsection 34A. And the company which is buying back, right, they will pay buyback tax under 115 series. Some taxation is there which we will discuss in CA final. Understood or not? Now the provision, you see, so cruel provision, so cruel. The provision is very cruel. If at all buyback happened on or after 1st April 2024, company paid you buyback amount. Company paid you buyback amount 10 crore. Straight away that is taxable under income from other sources. Straight away it is taxable under income from other sources as dividend. It is treated as what? Deemed dividend. It is treated as deemed dividend. 2 subsection 22 clause F, which is newly added. Which is newly added. Straight away the buyback amount is taxable after, in other sources if the buyback is on or after 1st October 2024. If the buyback is on or after 1st October 2024. Suppose, this is, now by the way, to get this 10 crore, I paid money and purchased shares. No, I purchased 6 crore worth of shares. The 6 crore worth of shares cancelled to me. And I received buyback loan 10 crore. Straight away 10 crore is taxable. What about my cost of acquisition? Don't worry. Under capital gains, full value of consideration, take it as 0. If buyback happened on or after 1st October 2024, take full value of consideration 0 under capital gains. What is the cost? 6 crore. Reduce it. The balance result will be 6 crore, short term capital loss or long term capital loss or whatever. Please set off and carry forward as per 70, 71, 74 sections. Nothing but we will discuss this in set off and carry forward provision, which is a cruel provision. You know, loss under the head capital gains, loss under the head capital is you cannot set off with other heads of income. You can only set off with capital gains. What if I don't have a capital gain? This entire cost of acquisition becomes useless. Tell me, I purchased shares at 6 crore, later I got 10 crore, profit is only 4, right? But you are taxing me 10 crore in other sources. And you are giving me deduction. You are giving me deduction in capital gains, but I can't set up these two, right? I can't set up these two, right? It's so bad provision. It's the worst provision. Getting it, worst amendment did for buyback. It's very, nowadays what companies has to do, you know, if at all they want to distribute money, don't buy back. Distribute as dividend happy. Distribute it as dividend happy. If shareholders want to sell the shares, they will sell in the open market to somebody and compute capital gains and claim 6 crore reduction, which is good. That's it. This is amendment in 46A. Under 46A, if any buyback of shares by domestic company happened on or after 1st October 2024, under the head capital gains, cost of acquisition of those shares shall be reduced from full value of consideration, which is to be taken as 0. The resultant figure is always a loss, long term, short term, set off and carry forward accordingly. Buyback amount is directly taxable under income from other sources to subsection 22, clause number F. Set. 46A is also over. Are you clear? Then let's look at slump sale. Let's look at slump sale. Once we cover slump sale, exemptions I will discuss. Just a minute. Where is slump sale section? 120? That's it. Yes. Now look at the slump sale. Now slump sale. So 50B slump sale. What is a slump sale? Very simple. You are selling one of your business segment, one of your business unit, one of your business undertaking, one division, one strategic business unit, one business vertical in GST. Now in business vertical concept is removed in GST, but anyhow, one of your division, you are not selling entire business, one division you are selling. Suppose you are having 3 divisions in your business. One division is dealing with manufacturing, one division is dealing with providing services, one division is dealing with some other activity. Services, what you are dealing with, you are selling it to somebody. You are not selling each and every asset inside that. You are selling service division itself fully. That is treated as what? Slump sale. Now, in a slump sale, how to compute capital gains? Straight away I have given here computation. In problem, they will give you at what price the unit is sold, at what price the division is sold, they will give you actual sale value, they will give you that. They will also give you market value of the unit sold, market value of the division sold, they will give you, whichever is higher. What is consideration you have to take in slump sale? Deemed full value of consideration, market value of the assets, whichever is higher, nothing but FMV of asset transferred. Don't worry about the wordings here. They will give you an exam. FMV of the unit sold, FMV of the division sold, they'll give you. FMV of the consideration received, they will give you. How much you received consideration, they'll give you. That you keep it. Minus transfer expenses, they will give you. Reduce it. Then what you will get? Net consideration. What you will get is net consideration. From that, generally how to compute capital gain? You should reduce cost of acquisition and cost of improvement so that you will get a capital gain or capital loss. Now, what is the cost of acquisition and cost of improvement? You are selling a division, right? Inside that so many assets and all were there, right? Each and every asset cost you should total it. No. Cost of acquisition is net worth. Cost of acquisition in case of a slump sale is net worth of the undertaking. Whatever undertaking is there, right? That net worth is to be taken as cost of acquisition. How to calculate this net worth? Very simple. How to calculate net worth? Net worth is calculated very simple. Total assets minus liabilities. Very simple. Assets minus liabilities. Now assets. How to consider the values? Suppose if it is a depreciable asset under income tax, then WDV value of that asset you should take. Remember, under when you are computing just a minute. Yes, sir. So now look at this. Yeah, sorry for the interruption. Now, total assets minus liabilities is equal to net worth. Now, net worth for depreciable assets, you should take what? WDV value. Remember, in PGBP, we compute assets block wise. Asset wise, we will not have details. In slump sale, no, some assets of a block only we will be selling. So that time, how to compute WDV? They will give you original cost details in the question. Minus, assume that is the only asset in the block. Assume that it is the only asset in the block. So calculate depreciation for every 31st March. Calculate depreciation for every 31st March from the date of its purchase. For every 31st March. Full rate or half rate. First time on first year it is either full rate or half rate. Second 31st March onwards, full rate. So suppose asset is purchased in 2019-20 year. Full rate. 2021 full rate. 21-22 full rate. 22-23 full rate. 23-24 full rate. 24-25 you sold it. In slump sale you transferred it. 24-25 don't apply depreciation. Very simple. For the year in which you are selling the asset and for the year in which you are selling the division, never apply depreciation for that year. Very simple logic. Getting it? So original cost minus depreciation as per WDV method. So you will get written down value. That value, depreciable asset value. Then, sir, self-generated asset, sir, value is to be nil. Any capital asset where deduction under 35 is claimed, sir, the value is to be taken as nil. Any other capital asset like land, stock in trade, current assets, goodwill, everything, book values. What is it? Book values. Debtors, creditors, cash and cash equivalent, everything, book values. Minus liabilities. Liabilities means what? Third party liabilities, all that. You reduce it. Then what you will get is called as net worth. That net worth is taken as what? Cost of acquisition and cost of improvement. Now you see sale value minus cost of acquisition is equal to capital gain. Actually slump sale is nothing but a goodwill taxation. Slump sale is nothing but a goodwill taxation. Whatever goodwill you are getting in accounting, this is actually called as what? Goodwill. Any amount I am receiving beyond my net worth, beyond my net asset value is treated as what? Goodwill. This is actually a goodwill taxation provision, section 50B. And remember, whether this is a long term or short term, this is the question. See, what are we selling in slump sale? We are selling the division. When the division opened, check out. When the division opened, operations check out. When it is sold, check out. More than 36 months, long term. Less than 36 months, short term. Sir, 36 months, after amendment 24 months only, no? No. For slump sale, 36 months, less than 36 months, that is told in the 50B section itself. So in 50B, there is no change happened. Right now, on or after 23rd July, listed securities, units of equity oriented mutual funds, units of Unit Trust of India, zero coupon bonds. For them 12 months. Any other capital asset 24 months. On or after 23rd July if the transfer is. However, that 24 months logic will not apply to slump sale. For slump sale, 36 months is the only criteria that is applicable. Clear? All of you? That's it. Slump sale is over. Slump sale is over mainly. Okay. Now let's look at exemptions. Now let's look at exemptions under capital gains. You know, we have totally, these exemptions, 54, 54B, 10 subsection 37, 54D, 54EC, 54F. 54D I will not discuss. Remaining all other I will discuss. And 54H I will discuss. Capital gain account scheme I will discuss. If at all we cover all these sections, that will be over. Now let's look at 54. What is 54 section says? Suppose I sold a long-term capital asset. I sold what? Long-term capital asset, which is a house property. What I sold? House property I sold, which is a long-term capital asset. Where the income for me until I sell, no. That income is taxable under which head of income? House property head of income. Sometimes in exam they'll give you compute total income problem. They'll give you what they will give you. You have a house property. You sold it on 1st October. The house property they will give you compute total income up to 30th September. Income from house property has to be computed for 6 months. Annual value. Then on 1st October, capital asset is transferred. So capital gains has to be computed. So many will compute only capital gains because capital gain information is given. House property information they will forget because 6 months you are owner of the house property. For 6 months you should compute annual value. That's it. You sold house property. Okay. Which is a long term. Okay. You are getting a capital gain. You are getting a capital gain. You will get exemption. You will get exemption. If you remember 48 format, full value of consideration minus transfer expenses is equal to net consideration minus cost of acquisition minus cost of improvement, then you will get gross long-term capital gain. Gross capital gain. From that you can claim one deduction. 54 series exemptions you can claim. Then you will get balanced taxable capital gain. Now we are discussing that 54 series exemption. If at all you got a gross capital gain, if you invest that amount in another house property, you will get exemption. Now, where I should invest? what I should invest, within what time I have to invest. This is the question. Very simple. You should invest in another house property. Now here investment is linked with the amount of capital gain. Here investment is linked with the amount of capital gain. Suppose gross capital gain, long-term capital gain is more than 2 crore. Then you can purchase only one house in India. You can only purchase one house. You can buy 2, 3, no problem. But you will get exemption only for one. But remember, in 54F also, you will get exemption only if you buy one property. But there you should not buy second house. In 54, you buy any, but you will get exemption only for one. But under 54F, you should not buy any number of your choice. You should only buy one. That one only you will get exemption. Remember 54F? Yes, so 54 exemption is available only if you invest in one house where the capital gain is exceeding 2 crore. Now within what time you should invest? 2 years from the date of transfer in case of purchase, 3 years from the date of transfer in case you are constructing it, or if you want to purchase, you can purchase in advance also before transfer date. First you purchase an asset and keep, then you sell the old house property. This exemption also can be claimed. Yes or no? Next, sir, capital gain is less than or equal to 2 crores. My gross gain is what? Less than or equal to 2 crore. Then you have 2 house property options. Then you can invest in 2 houses. Same time limit. 1 year before, 2 years after the date of transfer for purchase, 3 years after the date of transfer for construction. Time limit is same. Getting it? Now, 2 houses you can buy. For the 2 houses you can get exemption. Remember, once the SSE claimed exemption for 2 houses one time in any one assessment year. For 2 houses you claimed exemption at a time. You are not eligible in your lifetime for claiming exemption for 2 houses once again. Next time onwards, when you are selling a house, again you are buying a house, one house only you can claim exemption. Able to understand. Now remember, what is the maximum exemption? How much amount invested and how much is the capital gain, whichever is lower. Remember, maximum exemption shall not exceed 10 crore. Maximum exemption shall not exceed 10 crore. How do we do this computation? Suppose I sold my old house, 20 crore I sold, minus cost of acquisition of this house is 10 crore. My long-term capital gain is what? 10 crore. Now I have to invest this 10 crore in another house. Since my capital gain is more than 2 crore, I can only invest in one house to get exemption. Getting it? You invest in multiple, you don't get exemption for multiple. You will get exemption only for one house purchase. Suppose one house itself I costed me 9 crore. So balance 1 crore is taxable. This 9 crore exemption I can claim. Able to understand. This is how you should compute. Now, now, for the new house, there is a lock-in period. You are purchasing new house, and claiming exemption, right? For that, there is a lock-in period of 3 years. What will happen if you sell that new house within 3 years? Very simple. When you are selling that new house within 3 years, you will compute capital gain rate on that anyhow. You will compute capital gain on that rate. Consideration, sir, new house, in our example, new house I purchased at 9 crores, sir, and I sold this in 25-26 year itself, sir. Full value of consideration of new house is what? Sorry, I sold it at 15 crores, sir. Next year, I got a very good money, I got a very good deal. I sold it at 15, sir. Minus, what is the cost of acquisition? 9 crore is the cost, sir, at which I purchased. Minus, exemption you claimed, no. Exemption you claimed earlier, no. And now after claiming exemption, you are selling within lock-in period. Earlier given exemption will be cancelled. How they are cancelling it here? Generally they need to retax it separately, but they are not retaxing. Under 54, 54B, 54D. Under 54, 54B, 54D. In all these 3 sections, earlier given exemption, they will not retax it separately. They will reduce it from the cost of acquisition. What is the cost of acquisition? 9 crore. How much exemption you claim? 9 crore only you claim. Balance cost is 0. So indirectly 15 crore is taxable on sale of the new house subsequently within the lock-in period. In this way they are retaxing. Whereas in 54EC, 54F, retaxation will not be done like this. Retaxation will be done separately, which is the right way of doing it. But under 54, 54B, 54D, they used these wordings. What? If the new asset is sold within the lock-in period, the new asset will be taxable. The new asset at the time of computing capital gain on the new asset from the cost of acquisition, old asset capital. From the cost of acquisition, earlier given exemption will be reduced. So this is the wordings which they used. In exam you should present like this. Suppose if the new asset is sold within lock-in period, compute capital gains on the new asset, full value on the new asset, how much? Less transfer expenses, how much? Remember, if it's a new house property means even section 50C also you should apply and check that time. Yes or no? Then minus transfer expenses, you will get net consideration. Cost of acquisition. In our example, cost of acquisition is what? 9 crore. Exemption claimed is what? 9 crore. Balance is 0. If on this balance, if some amount is there, indexation will be available on this. But anyhow, since these will be on or after 23rd July, indexation is not available. So cost of improvement, reduce it. Then finally, you will get balance capital gain or balance capital loss to be taxed. Able to understand, all of you. Now let's look at capital gain account scheme. What is a capital gain account scheme? Very simple. See, you sold a house. Now you got a capital gain of 10 crore. You got a capital gain. Remember, under 54F, the exemption is amount invested in new house, either 1 or 2, as the case may be, or capital gain, whichever is lower. Whichever is lower. That much only exemption available. That too, amount invested beyond 10 crore, don't consider. Amount invested beyond 10 crore, don't consider. Indirectly, under 54, exemption cannot exceed 10 crore. Able to understand. Now, capital gain account scheme. What is a capital gain account scheme? Very simple. Sir, in 24-25 year, I sold a house, sir. And I got a capital gain of 10 crore, sir. I need to use this to buy another house, right? I need to use this 10 crore worth of money to buy another house, right? What is the time available? 2 years, 3 years is there. But I should file IT return by 31st July. I should file IT return by 31st October, due date. By due date, you didn't spend any single rupee. Department is saying only one thing. By due date, either buy or construct. No problem. You have 3 years time, no? Don't wait up to that. You construct. You don't want to construct. You have 3 years option. You want to use the 3 years option. Then do one thing. Whatever capital gain is there, whatever exemption you want to claim, that amount deposit in a bank account. That bank account name is called as bank account opened under capital gain account scheme. By what time you should deposit here? By due date mentioned under 139 subsection 1. By due date mentioned under 139 subsection 1, you should deposit in a bank account. You should deposit in a bank account mentioned under 139 subsection 1, or you directly purchase a house, construct a house on or before 139 subsection 1. Either you purchase or you deposit in bank account, whatever it is, but by due date it must happen. If at all you deposit the amount in capital gain account scheme by due date, whatever amount you deposited, whatever gain you have, whichever is lower, that much you can claim exemption, subject to maximum of 10 crore. Able to understand, all of you. Now remember, from this capital gain account scheme, as per the time limits given in the section, 3 years from the date of transfer, 2 years from the date of transfer for purchase, within these time limits, from this account you withdraw the money and then spend. For sure you have to spend it for purchase or construction. Suppose, sir, time limit is over, sir, still some amount is left in account, sir, bank account, unutilized amount in capital gain account scheme, what I should do? On that amount, if you claimed exemption at the time of deposit, retax it. On that amount, if you claimed exemption earlier, at the time of depositing into account, you claimed exemption, you got exemption, that amount, then retax it. Simple. Able to understand. Capital gain account scheme, unutilized amount, straight away retax it. No, that's wrong. If at all exemption is claimed earlier on the deposit amount, then only it is retaxable. Able to understand. That's capital gain account scheme logic. Okay, capital gain account scheme is applicable for all sections except 54 EC. Except 54 EC, because in 54 EC you should invest in bonds within 6 months. That's 54 EC or not? All of you. Now let's look at 54 EC. 54 EC. Now let's look at 54 EC. I'll come back to agricultural land, all that later. 54 EC. What are you selling? Any long-term asset. You are selling any asset, but it should be long-term. You got a capital gain. Okay, no problem. You got a capital gain. What you have to do? Sir, I don't want to pay tax on this capital gain, sir. What I have to do? Invest that. Invest in the gain amount. Where should I invest? Invest in specified bonds. Within what time, sir? 6 months only from the date of transfer of the original asset. From the original asset transfer date, 6 months. What is a specified bond? Bonds issued by National Highway Authority, bonds issued by Rural Electrification Corporation, bonds issued by Power Financial Corporation. PFC means what? Power Financial Corporation. Bonds issued by IRFC, Indian Railway Financial Corporation. 4 types of bonds: NHAI, Rural Electrification, Power Financial Corporation, National Highway, Indian Railway Financial Corporation. These 4 entities related bonds you buy. Whatever amount you paid here for purchasing these bonds, within 6 months only you purchase, you will get exemption. So whatever amount you invested within 6 months in these bonds, that much amount is exempted. Maximum exemption cannot exceed 50 lakh under 54 EC. Under 54 EC you can't claim. Suppose, sir, I am selling a house property, sir. Long term, sir. and I buy house property, sir. 1 or 2 houses, as the case may, I will buy and claim exemption. Can I also simultaneously invest in 54 EC bonds and claim exemption both? Yes, you can claim. So that's what here we have given as a diagram. Able to understand, all of you. Now, what is the lock-in period for bonds? 5 years. Within 5 years from the date of investment in bond, you should not sell it. You should not keep them in loan also. You cannot keep them in loan also. If you sell or keep them in loan, earlier given exemption up to 5 lakhs exemption is there, right? That is fully retaxable in the year in which you sell it, in the year in which you kept them as a loan, that time it is fully retaxable. Able to understand? Then that is 54 EC. Now 54F. 54F is a little different section. Now, for example, look at 54. Look at 54. Look at 54. Suppose, sir, I sold house. I sold house. For example, I sold house for 20 crores, sir. I sold house for 20 crores, sir. House I sold. House I'm selling. I'm telling you, house. Minus cost of acquisition, some 15 crores, sir. My capital gain is what? 5 crore. Under 54, I should buy another house, right? If I invest 5 crore in another house, one house only, because it is more than 2 crore. If I invest in another house, entire 5 crore I can claim exemption, right? How much I should invest to get 5 crore exemption? 5 crore only. But under 54F, original asset you are transferring is any long-term capital asset other than house property. What you are selling originally, any property, but not house property. But not house property. Sir, I am selling a land, sir. I am selling jewelry. I am selling listed equity shares. I am selling equity oriented mutual funds. I am selling business trust units. I am selling some assets, sir. Yes, any asset is covered under 54F. I am selling some asset, but it is a long term. Minus, okay, long term. At what price you sold, full value of consideration 20 crores, sir. Minus what price you purchased that land, sir, I purchased it at 15 crores, sir. What is the capital gain? 5 crore. Now, in 54F, what you should purchase? Under 54F, what you should purchase? You should purchase house property. Original asset, any asset other than house. Investment in house property. Whereas 54, original asset, house property. Investment in also house property. Whereas in 54F, original asset, any asset other than house. Asset you are going to purchase must be house. Now, house property you need to purchase. In order to claim exemption, you need to purchase house property. How much you should invest? If you want to get 5 crore exemption, entire 20 crore you should invest. Here, exemption is linked with long-term capital gain into amount invested divided by net consideration. Long-term capital gain 5 crore. Net consideration is what in our question? 20 crore. Amount invested. Sir, I invested entire 20 crore, sir. No. Amount invested beyond 10 crore shall be ignored. Amount invested beyond 10 crore shall be ignored. Sir, I invested entire 20 crore and bought the house. Doesn't matter. 10 crore only I will consider amount investment. So accordingly, 2.5 crore only exempted. How much is exempted? 2.5. So balance 2.5 is taxable as a capital gain. Understood or not? Suppose now SSC also bought bonds 54 years. That also you claim exemption. No problem. Able to understand. Further. Sir, I didn't invest 10 crores, sir. I didn't invest 20, sir. I invested only 5 crores, sir. Then accordingly, exemption will be 1.25 crore. That's it. So exemption under 54F is not amount invested directly. Amount invested divided by net consideration. That proportionate you will get exemption from capital gain. Able to understand? And remember, in 54F, amount invested more than 10 crore shall not be considered. Getting it? Which means the sections are drafted only with a view to help normal taxpayers, not high rich affluent people. Able to understand? That's it. So that's 54F. Now in 54F you have few different conditions. By the way, individual and HF only. 54 is also applicable for individual and HF. 54F is also applicable for individual and HF. Resident or non-resident doesn't matter here because there is no specification. Able to understand? Now conditions. New asset you should purchase. What? One house property in India you should purchase. Same time limit given under 54. 1 year before, 2 years after, 3 years after, all that. The SSC must not own one house on the date of transfer. You are selling some land, right? That time how many houses you can have in your name? One house only you should have in your name. If at all you want to claim 54F exemption, 54F exemption if you want to claim, already how many houses you can be owner? Only one house. Now you are claiming 54F exemption by investing in another house, right? That must be your second house. Maximum either it should be a first house or it should be a second house. Okay, fine. Sir, I invested in claimed exemption, sir. I want to buy another house, sir. Don't buy. 2 years, don't buy. 3 years, don't construct third house. If at all you are doing another purchase of house or another, see, simple, you sold land, within 2 years or within 3 years, only one house you buy or construct. If you buy 2 houses or 3 houses, for example, you will not at all get exemption under 54F. Suppose you bought one house and claimed exemption. In the same 2 years gap, later after claiming exemption, you bought another house. It's a condition violation. Earlier given exemption will be retaxable. That's 54F. Able to understand. Now here also capital gain account scheme is applicable as usual. Capital gain account scheme is applicable. Now how much amount I should deposit in capital gain account scheme, how much exemption you want, accordingly how much amount you should invest in net consideration proportion, that proportion only you have to invest in capital gain account scheme. Here I have given examples. In the book I have given examples. Please go through these examples. That will be over. Able to understand. 54F is over. Now 54B and 54 urban agriculture land. I am talking about urban agricultural land. There are 2 sections dealing with exemptions. 10 subsection 37, 54B. Sir, what I am selling is an urban agricultural land. What I am selling is a urban agricultural land. Sir, it is sold under compulsory acquisition. It is sold under compulsory acquisition. Remember, this urban agricultural land is used by me for agriculture purpose for 2 years. This urban agricultural land is used by me for 2 years for agriculture purpose. Agriculture purpose, 2 years we are using it. Urban agriculture land. You know, 2 years we are using. SSC or his parents or the HUF, they are only using past 2 years. Now it was sold to government under compulsory acquisition. Fully exempt. Straight away exempt. Urban land. Remember, if it's a rural land, there is no question of capital gains at all. Sir, I am selling it to somebody else, sir, not government under compulsory. I am normally selling, sir, urban agriculture land. Now, can I get any exemption? Yes. Within 2 years, within 2 years, by purchase another agriculture land. What is it? Purchase another agriculture land. This new land you are purchasing, right? This may be urban or this may be rural. Doesn't matter. You buy a new land, you will get exemption. How much amount you will get exemption? How much amount you invested in the new land? That much amount is exempted. Able to understand. Now, new agriculture land, lock-in period is what? 3 years. Same way in 54F also, new house property, lock-in period is what? 3 years. You know, in 54F and 54EC, both the cases, if the asset is sold in lock-in period, it is retaxable separately. Earlier given exemption is retaxable separately. Under 54B, retaxation will be like 54. How it is retaxable under 54B? Suppose I am selling new land within lock-in period. I will compute capital gains on the new agriculture land, right? Provided if it is an urban land. Provided if it is a urban land. Then while computing capital gains, cost of acquisition will be there, right? From that cost of acquisition, earlier given exemption will be reduced. Balance cost will be, you know, reduced from the sale consideration, and balance will be liable for capital gains tax. Yes or no? No. Sir, what if I invested in new land and the new land is a rural land? Rural land is sold within lock-in period. No tax treatment. Earlier given exemption is not taxable. Since it's a rural land, new land, no tax treatment at all. That is 54B, 10 subsection 37. Are you clear? That's it. Now finally there is a section called 54H. What is 54H talking about? See, when any capital asset is compulsorily acquired, when any capital asset is compulsorily acquired, you will receive compensation somewhere later. But under 54, 54B, 54EC, in all these cases, you should compute time limit from which date? From date of transfer you should compute. Capital gain account scheme also you should for the same year only you should deposit. No. Sir, my asset is compulsorily acquired. I did not get single rupee. You are starting, you are saying, you are starting computation of time limit already. Computation of time limit will not be from the date of transfer. In case of transfer by compulsory acquisition, computation of time limit for investments in new asset will not be from the date of transfer. They will be computed from the original They will be computed from the date of receiving the compensation. They will time limit computation will start. Time limit computation will start from the date of receiving the compensation, not from the date of transfer. Thank God they gave a benefit. That is what 54H is talking about. Able to understand. That's it. Predominantly capital gains is over. Only one section I didn't cover is 46. 46 I will discuss in income from other sources. Liquidation topic is there. Liquidation topic at that time I will discuss 46 section also. Distribution of capital asset by the liquidation. Distribution of capital asset by the company under liquidation. You know, in period of holding, date of liquidation will be the right. After the date, shares holding period we will not consider. Now, assets distributed on liquidation to shareholder, right? Market value of the asset on the date of liquidation minus deemed dividend is full value of consideration minus cost of acquisition is equal to shares acquired by the shareholder in the company. Balance is capital gain. Able to understand? Now, sir, the asset which I got now in liquidation, I sold subsequently. What is the cost of acquisition for that asset? Sale value, I know. Cost of acquisition is what? Market value you considered at the time of distribution. Market value you considered at the time of distribution. That itself is the cost of acquisition. Able to understand? Previous owner, company holding period will also be considered as part of my holding period when I am computing holding period to decide whether the asset is a long term or short term. That's it. Anyhow, once again, this liquidation topic I will cover in income from other sources revision. Almost we spent close to 3 hours on capital gains. Only revision. That too, how intense I did. Getting it? That too, we did all illustrations roughly. Some random numbers we took and then did that. You apply this logic and solve your problems. I'm telling you, 99% you will be done. Clear? That's it. Yes. Let's discuss the revision of capital gains, which is again applicable for May 25 and September 25 and January 26. This is the chapter where major amendments happened. Predominant amendments happened in capital gains. Generally, capital gains itself is a one complex chapter because of so many dates, so many provisions, so many conditions, so many situations they will cover. Now it became even more complicated. But anyhow, let's break down the entire capital gains. Like many students in this capital gains, they ask me, sir, what are the amendments in capital gains? Only amendments they want to read. No, never read amendments part in capital gains directly. You will not understand. Read the entire chapter as per amended provision. And that is what right now we are doing. Capital gains, right now we are discussing straight away the amended provision. And you listen to this particular revision of capital gains, I'm telling you, you generally get complete clarity. Everywhere, wherever amendment is there, I will specifically point out. Okay, now in capital gains, the major thing is there are 4 dates that you should remember in this chapter, and there are 4 rates that you should remember in this chapter. These rates are applicable for long-term capital gains. These rates are applicable for short-term capital gains. 111A section. There is another short-term capital gain which is taxable at normal rates. There is another short-term, there is another capital gain, another short-term capital gain which is applicable at normal rate. But don't worry, let's not discuss immediately into this. 4 dates, 4 rates, this point I will come back. Okay, this point I will come back. What are the 4 rates that are there in the capital gains? What are the 4 dates that are available in capital gains? I'll come back. Now, most important, in capital gains, how do we compute capital gains? This is the first question. Normally, when you're learning capital gains, in what order you learn, that's different. But when you're revising the capital gain, there is a particular order in which you should revise. Therefore, you get ultimate command on the subject. Now, how to what is the let's begin the actual capital gains revision discussion. Capital gains will be computed in 2 parts. Capital gains can be computed in 2 different ways. One, for non-depreciable assets. Capital gains is computed for what? Non-depreciable assets. And depreciable assets. What is it? Depreciable assets. Non-depreciable assets, capital gain computation is available under 48. Depreciable assets, capital gain computation is given under 50 and 50A. Apart from this, there are few more sections which talk about computation of capital gain. There are few more sections which talk about computation of capital gains, that is 46, liquidation, on account of liquidation. Then 46A, computation of capital gain on buyback, computation of capital gains on buyback. There is another section which is also talking about capital gains for market linked debentures, units of specified mutual fund, unlisted debentures, unlisted bonds with effect from 23rd July. This section has an amendment. Getting it? And there is another section which also talks about computation of capital gain is slump sale. There is another section which is also talking about computation of capital gain is slump sale. Now, so this is the capital gain computation format. This is the situations under which you should compute capital gains. Remember, don't deviate. There is an order which I am discussing. If you listen to this order, if you listen through this order, every point I will connect. Now, how to compute capital gains for depreciable assets? First, let us look at this. Already, this point we will discuss in PGBP revision. We would have already discussed this in PGBP revision, but briefly once again I will tell you. How to compute capital gains on depreciable assets? Very simple. In depreciable assets, you sold full block. You sold full block. Full block is transferred. Full block is transferred. As on 31st March of the relevant previous year, a particular block is not at all there. 1st April the block is there, but 31st March the block is not there, which means the block itself is ceased to exist. Now, how to compute capital gains? First, identify gross block value. First, identify gross block value. What do you mean by gross block value? Opening WDV plus additions during the year plus transfer expenses during that year. Transfer expenses incurred on transfer of the block. See, this point is what I already given you in the book also. In the book also, I have clearly given you this point. This point I have given, just a minute, it's loading. Yeah. You see here,